think we have more than 60 participants. Can we start, Brother Omar?
Yes, I think we should start. It's 9:03. Maybe we can wait two more minutes. I would suggest we start at 9:05.
Okay, then.
Brother Majd, I think we should start.
Okay, brother. We start. Just drop a message to Islamic Economy. Okay, Bismillah ar-Rahman ar-Rahim. Alhamdulillah Rabbil Alameen wa salatu wa salamu ala Sayyidina Muhammad wa ala alihi wa sahbihi ajma'in. Ladies and gentlemen, sisters and brothers, Assalamu alaikum wa rahmatullahi wa barakatuh. And welcome to another round of AAOIFI's public hearings on newly issued exposure drafts of financial accounting standards. Particularly for today's session, the exposure draft on presentation and disclosures in the financial statements of Takaful institutions, and the exposure draft on accounting for Takaful recognition and measurement. This public hearing is being held in collaboration with KNEKS, National Committee for Islamic Economy and Finance in the Republic of Indonesia, and with the particular support from their management and team. On that occasion, I would like to extend our heartfelt thanks to Dr. Sultan Emir Hidayat, Director, and Sondra Mawan Samidi, Policy Analyst at the committee, National Committee, for their kind support and collaboration. As you may know, the public hearings constitute one of the 13 mandatory steps in the standard development process undertaken by AAOIFI, and such industry-level events are designed to interact with and benefit from the knowledge and experience and educated thought lines of experts and professionals on the newly issued exposure drafts. Today, we have two sessions, one for each of the above-mentioned exposure drafts, which will be presented and coordinated by AAOIFI's Secretary General, Mr. Omar Mustafa Ansari, who will walk you through and shed particular light on these two draft standards while addressing your inquiries and discussing your remarks and feedback before compilation and submission of them. these feedback and remarks to the respective working group for further elaboration and consideration before presenting the updated version of these drafts to AAOIFI's accounting board. Accounting board in its turn and in its upcoming meeting will consider the modified version of these two drafts in light of the discussions held at the public hearings at the 2 weeks of the public hearings and the final input of the respective working group, and will make the changes it deems fit prior to the final issuance of the standards. Before we move on to the core sessions of today's public hearing, allow me to provide a summary or a background perspective about the overall review process that was undertaken by AAOIFI's accounting board and respective working groups, revisiting existing financial accounting standards on Takaful and other relevant standards, like FAS 1 on general representation disclosure in the financial statements, which was revised 2021. This summary will include a review or include topics like review objectives, timeline, and as well as the objective and scopes of the new standards, among others. So allow me now to move on to the review timeline that will, I'll try my best to be sure and to provide or shed light on the review process for the existing Takaful standards, which are namely or the more relevant standards for the Takaful project, Takaful review projects, where FAS 1 general representation and disclosure, FAS 12 general representation disclosures in the financial statements of Islamic insurance companies, FAS 13 disclosure of basis for determining and allocating surplus or deficit in Islamic insurance companies, FAS 15 provisions and reserves in Islamic insurance companies, and FAS 19 contributions in Islamic insurance companies. The FASs that were under review, as I mentioned, the requirement in this standard were considered by the respective committee, and in light of the IFRS requirements on the existing accounting, AAOIFI accounting and auditing and governance standards, such as IFRS 9 requirements on Islamic insurance companies' assets, IFRS 17 requirements on audit, IFRS 17 requirements on governance, given that IFRS 17 is a principle-based reporting. The FASs under review, the revision process or review process involved evaluating the requirements of IFRS 17, which were found to have an impact on the then in issue FASs, including FAS 1, FAS 12, FAS 13, FAS 15, and FAS 19. The then existing FASs also followed IFRS 4 accounting standards where applicable. However, the International Accounting Standard Board issued IFRS 17, which superseded IFRS 4. Similarly, IFRS 9 was issued, which superseded IAS 39. Hence, there was a need to revise the AAOIFI's FAS accounting standards, which mainly applies to Islamic insurance or Takaful firms. I'll try to be short, very short, before we move on, and I leave the floor for Brother Omar, AAOIFI Secretary General. The review objective of the project that was undertaken by AAOIFI's accounting board on existing Takaful standards, considered comparability and other considerations in terms of making financial statements of Takaful institutions transparent, fair, understandable, and comparable. Also, it's considered the element of aligning accounting treatments and reporting requirements of Takaful institutions with the general accepted accounting standards or principles gap to the maximum extent possible. The review timeline, just like a synopsis about the process historically, from 1993 to 2003, AAOIFI issued 4 financial accounting standards, the above mentioned standards. In 2013, at the time, the then Accounting and Auditing and Governance Standards Board, as it was named, initiated a comprehensive revision project for FAS on Takaful. In 2016, the project was put on hold by the newly formed AAOIFI Accounting Board, considering that the Takaful regulations were undergoing enhancement at the time, and that projects on insurance accounting were in progress towards finalization. Between 2016 and 2017, the board, AAOIFI Accounting Board, decided to give priority to a major project named AAOIFI Conceptual Framework, the revision project, and the FAS1 revision project. The board also decided to provide for common requirements for general representation and disclosures, which was the first leg of the project. Certain parts or sections and terminologies were being introduced to upcoming standards, and hence this required a degree of consistency across different standards and the new framework and the standard FAS1, as we call it. In 2018, the board initiated the comprehensive revision projects for financial accounting standards, as was recommended by the working group in charge of the FAS review revision project. In November 2018, particularly, the first working group meeting was held, and the first initial draft of the preliminary study was presented, where scope and major changes to the then existing FASs were discussed. In December 2018, new requirements of international standards were discussed and noted at the second working group meeting held towards the end of the year in September that year. In March 2019, specific deliverables and key areas of the projects were identified and discussed at the third meeting of the working group. In 2020, six working group meetings were held mainly in the second half of the year for discussions on industry survey, the main questions that were addressed to the industry. Then the first exposure draft of presentation or disclosure of FAS, and the second exposure draft, which featured the core principles, and the third version of the exposure draft. The exposure draft was submitted to the board in November 2020 for its review and approval for issuance. In November 2020, the updated exposure draft was submitted to the board at its meeting number 21, held in November, and the board reviewed it and considered recommendations of the working group and then approved the draft for issuance. In January 2021, pursuant to additional rounds of working group reviews and fine-tuning, the exposure draft was issued on the 26th January 2021. In the same month, January 2021, after having issued the exposure of the presentation disclosures, FAS, and the exposure standard, financial accounting standard, work immediately started on the 28th of January in the 9th meeting of the working group on the second leg of the Takaful FAS review project, which was to focus on the accounting treatments for Takaful in line with global best practices. At that meeting, the revised scope and updates of the new requirements were discussed, including Sharia implications. During the year 2021, multiple working group meetings were held during the year, and where commonalities with international standards along with potential Sharia issues were also discussed at length. In April 2021, the first version of the draft standard was presented to the 11th working group meeting. The working group at that meeting suggested recommendations on core principles. In May 2021, the second version of the exposure draft was discussed and necessary changes were made and incorporated. And the third version was also discussed, and the exposure draft was then submitted to the board at its 24th meeting for further discussion. The board approved the exposure draft for issuance in August 2021 after having incorporated the board's comments and following an additional round of review by the working group. The export draft was formally issued on the 26th of August 2021. This is in a hurry. Just a summary. The main components of the projects and the timeline of behind the review process. Let me now move on, and we will have, as I said earlier, AAOIFI Secretary General, Mr. Omar Mustafa Al-Ansari, who will walk you through the two exposure drafts in length. He will address your questions, and he will also provide AAOIFI's perspective on such comments and feedback while we walk you through the two standards towards in the two sessions that we will have today. The first session will tackle the first standard, the exposure standard, and while the second session will particularly tackle the second standard, which is standard on recognition and measurement. So with that, at this rate, I leave the floor for Brother Omar Ansari. Brother Omar, the floor is yours. Thank you very much, everybody. And to Brother Omar. Brother Omar.
Thank you, Brother Majd. A'udhu billahi minash shaitanir rajeem. Bismillahir rahmanir rahim. Rabbi shrah li sadri wa yassir li amri wahlul 'uqdatam min lisani yafqahu qawli. Ladies and gentlemen, distinguished guests, Assalamu alaikum wa rahmatullahi wa barakatuh. This is a great pleasure to be in front of you discussing one of the very important projects of AAOIFI, the outcome of one of the most important projects of AAOIFI, that is our Takaful standards on the financial accounting side. Brother Majd has very ably discussed about the need and about the timeline and about the steps from which we have gone through. Just I would like to emphasize one thing on before going through this set of standards. From our perspective as a standard setting body, this is very important that all our standards are not just set in isolation. They are rather developed with appropriate industry input and stakeholders input at all stages. This includes the stage of development, in which we take in proper industry and other stakeholders representation in our working groups, and obviously our board is already well represented. And then we take the Sharia input, we take the input from the Public Interest Monitoring Committee from the context of the public interest. But the most important of it is taking comments at large. And for this one, this standards and these two standards, we are particularly performing multiple activities, including multiple public hearings in English and Arabic language, as well as a roundtable. And we have received a lot of written comments, and we are still inviting the comments. But now it is time that we need to conclude the project and take it to its eventual finalization, particularly considering that in most parts of the world, effective 1st January 2023, IFRS 17 will become applicable. So from our perspective, one of the exposure drafts right now has an effective date of 2022 and one has 23 and 24. But we believe that both of them will have the same effective date, that is 2024. So it means that our standard will become applicable 1 year later than IFRS 17. However, we understand that some of the regulators are insisting on finalizing making IFRS 17 applicable from next year, even on the Takaful. So for them, this is a choice to adopt our standard on a early adoption basis from 1st January 2023. So we are planning to finalize the standard within next 2-3 months, inshallah. In September, we are holding our board meeting, and before that, we'll complete this process, inshallah. So we are going to compile the comments and take them to the working group. and incorporate whatever necessary changes are there. There were some queries received by us from time to time, verbally, in writing, etc. Some of the most important queries were related to number one, effective date, number two, certain apparent inconsistencies between the two standards, the general presentation standard versus the recognition and measurement standard. We have clarified, and we would like to clarify again here, that based on the decision of the board, both standards will have one single effective date, as I mentioned, hopefully for January 2024, but the board may decide, if considering the comments, to give further extension to that. The second thing is that irrespective of what comments we receive, one thing needs to be done at our part, that is alignment of the two standards, because first standard was finalized in 2020, and the second one, after thorough further research and detailed work, was finalized in 2021. So there are some of the technical terms and jargons, as well as very minor presentation differences which still are there and which need to be aligned between the two standards. With that, I would just like to request that please feel free to interact today. We will see, depending on the number of questions that we receive in the Q&A tab, we may allow you to speak, open up your microphone as well, if the time permits. Otherwise, we'll try to take into consideration each and every comment that we receive in QA tab. Please put everything in QA tab, not in the chat tab, because in QA tab, it's easier for us to keep a track, and it's not possible for me or for our team to go every time to the chat window and find the questions. In the QA tab, whatever comes, we'll try to answer it one by one by name, and if necessary, we can allow and if the time permits, we can allow the participant to raise the question as well. However, I believe that if there are more questions, there is still a possibility that we can take the comments directly to the working group. One more clarification that I provide every time: there are a lot of questions and comments that we receive, and I respond to them. When I respond to them, does not mean that we are sort of killing the comment. No, it's not like that. Rather, when I provide the response, it means that I'm providing a response based on the discussions and research that has been done during the earlier phases of the project. But the comments are taken, and these are considered by the working group, and where necessary by the board as well. All the comments are provided to the working group and even to the board. Although board normally does not discuss each and every comment, board discusses only the significant comments, but working group normally discusses each and every comment. So all your comments which are received during the public hearing sessions, as well as those received in writing, are considered, and we take record of them, and we conclude on each one of them. More important ones actually are reflected in our basis of conclusion as well. With that, I think I should move on with the first standard. Just allow me to share my screen, please. Zoom gives a message that participants can see your screen, and I hope it is correct. And unless if people are unable to see the screen, they can let me know. This standard, presentation and disclosure in the financial statements of Takaful institutions. This is revising our earlier FAS 12, and it is to be read with our new FAS 1. Even the earlier one actually had a reference to earlier FAS 1, but now the new FAS 1, General Presentation and Disclosure in the Financial Statements of Islamic Financial Institutions, is actually a comprehensive standard and covers so many things which apply on all types of Islamic financial institutions, including Takaful and mutual funds and others. So while we have a specific general presentation and disclosure standard like this, which will replace FAS 12, but it is still to be read in conjunction with FAS 1. It is not our first public hearing. We have conducted public hearing earlier and a roundtable earlier as well. So maybe this time I'll try to focus on some more important issues toward the end of the standard, but still it's very important to give a brief. For those particularly who are new to the topic of Takaful or those who are attending from the jurisdictions where AAOIFI standards are not applicable and rather IFRS is applicable, I believe it's very important that I discuss some conceptual elements before I actually take you through the standard. Those conceptual elements are very important to understand because those are the ones from where we actually decided as to where and how we define the accounting standard and the accounting presentation and disclosures. For this purpose, it's a good idea. We have included a brief in our second standard as well. Let me take you to that brief. That might be even helpful because it will save time when we reach there in the second part of our today's discussion. So allow me to share that one. This is I think you can see the screen now. This is part A of the recognition and measurement standard, that is structure of Takaful. At AAOIFI, we believe that Islamic finance is different from the conventional finance. It's a simple statement, very simple, but actually it justifies the reason for existence of AAOIFI and IFSB and other infrastructure bodies of Islamic finance, or even before that, even the existence of Islamic finance itself. So if Islamic finance was not different from conventional finance, and if Islamic finance was just a replica, or sorry to say, a bad replica of conventional finance, then there was no need of having Islamic finance in itself or having anything related to Islamic finance, including Islamic financial accounting standards or Sharia standards, etc. We believe that Islamic finance is different, and it is, although it has so many apparent similarities with the conventional finance, yet the philosophy and the underlying structures and the contracts and the transactions and the risk profiles of those transactions and the balances and results of operations, they all differ from the conventional finance in so many ways. So for that purpose, we first need to understand the structure of Takaful. And let me put a question to the audience as well. You can answer in the Q&A tab. We have put this part A structure of Takaful in the recognition and measurement standard. Do you think it's important to either duplicate it in the general presentation and disclosure standard where it was not included, or rather to move it from the recognition and measurement standard to general presentation standard only? I'm just putting this question to the audience, particularly those who have read the standard, once I take you through this, it will be a good idea if we can have an answer to this by the audience in the Q&A tab, that whether you believe that it's okay to keep it in the recognition or measurement standard, or we should bring it to the general presentation and disclosure standard, or should we put this in both? So now what is Takaful structure? Takaful institution. The Takaful institution manages Takaful operations based on a remunerated Wakala agency contract. The Takaful institution may also assume the responsibility of investing the assets of the participants Takaful fund and participants investment fund through Mudarba or investment agency Al Wakala bil Istismar. The relationship between the Takaful institution and the PTF is principal agent in nature. The Takaful institution exercises powers over the PTF in fiduciary capacity as an agent and does not assume the risk or reward related to Takaful underwriting operations, particularly the net underwriting result, which is entirely in entirety relate to the participants. This is a very important point here. Let me just mention that we develop all our accounting standards in line with our Sharia standards. So it means that our accounting standards reflect the financial reporting requirements of what is written in our Sharia standards. So our Sharia standards actually, out of the 4 common models of Takaful which are available in the world, the first one being Wakala model, which is the main model covered by AAOIFI, and we develop our standard based on that. The second model is Mudarba model, which actually shares in the underwriting results, which we believe is not in line with the Sharia standards, and hence we do not cover it. Third model is cooperative model, which also, like Mudarba model, covers it's not actually Takaful model, but it's considered to be an Islamic insurance model, and it covers the underwriting results are also considered to be like, you know, shared by the shareholders. So we, again, because of the same ground, we don't consider it. The fourth model is Wakala Waqf model, which we believe is very similar to Wakala model. The only difference is that the PTF is given a status of Waqf, which means that the Waqf becomes a legal entity. Even our standard says that our participant Takaful fund is a virtual entity anyway, but when you create it as a Waqf, it becomes a legal entity from Sharia and legal standpoint. So there are some minor differences, but the core principle remains the same, particularly with regard to the sharing of risk and reward. And accordingly, our standard, these standards are applicable on Wakala model and Wakala Waqf model. And these are not applicable on Mudarba model or cooperative insurance model. Here, my issue is not to justify what is Sharia compliant and what is not Sharia compliant. My argument is only what is in line with AAOIFI Sharia standards, which we believe is the best interpretation of Sharia, and what is not in line with AAOIFI Sharia standards. So I would like to clarify that that the Mudarba model, the cooperative model, and the recently emerging Taseer model, which is primarily a conventional insurance model, not even close to cooperative or to Wakala model. These 3 models, the Taseer model, the Mudarba model, and the cooperative model, these are not in line with Sharia standards of AAOIFI. Hence, these are not covered by our accounting standard as well. So we are very clear on this part, and that is the reason that we have put it as a very important element in this relationship. Takaful, the Mudarib share on performance incentives accruing to Takaful institution out of the investment results or a lack thereof are in the nature of Wakala fee and cannot be construed as variable returns for the purpose of determining control. The Takaful institution is not entitled to any surplus arising in the PTF. In case where the PTF incurs the loss, the Takaful institution is not obliged to absorb the loss. Nevertheless, the Takaful institution may be obligated through regulation or market practice or through its constitution documents to temporarily support the PTF by providing Qard Hasan interest-free loan. Takaful institution, PTF and PIF are distinct reporting entities, although in most cases the PTF or PIF are virtual entities. Participant Takaful Fund. The participants or members desirous of sharing risk in a Sharia-compliant manner make contributions in the form of donation, tabarru being a non-commutative, non-exchange contract to the PTF. The PTF, by its very nature, is a virtual entity that maintains separate accounting records and is subject to financial reporting separately. PTF's activities and investments are managed under fiduciary capacity by the Takaful institution. For the management activity, a wakala fee for management services is paid by PTF to the Takaful institution, whereas additionally a mudarib share or wakala fee with or without incentive is paid by the PTF to the Takaful institution for investment management activity. PTF is obligated to pay the benefits to and on behalf of the participants according to their membership rights and entitlements for benefits to which they become eligible under the Takaful arrangement. PTF shall accrue a surplus or deficit at the end of the reporting period that shall be attributable to the participants in its entirety and then shall in no case be passed on to the Takaful institution. The Qard Hasan where received from the Takaful institution is a liability for the PTF that needs to be paid back. The PTF shall pay back the Qard Hasan whenever it accrues the next surplus and or has enough liquidity. Participants Investment Fund. The PIF, where applicable, is the investment fund in form of a virtual entity where the participants' investments component, which is a component of the overall Takaful arrangement, normally under a separate agreement, is maintained and managed. The participants of the PTF are the investment account holders of the PIF. The PIF shall maintain separate accounting records in respect of each of the investing participants. The Takaful institutions usually has a mudarba contract of sharing profit or an investment agency al-wakala bil istismar contract, normally with incentives with the PIF. So this is the structure of the Takaful entities, and this structure is very important to understand for the purpose of the general disclosure and presentation requirements that we are going to discuss and the accounting requirements that we are going to discuss in later part of today's discussion. Okay, so we are coming back to first standard, but let me take the comments now. So we have received Brother Ridwan Patel, prefer streamlined statements with minimal repetition. Sister Rashda Ainapur, no need to put to general presentation and disclosure standard. Noor Nakhatu, I believe you should maintain the structure in the recognition and measurement ED, but include a reference in the presentation ED. Very good. I think good comments. I think this is the best comment, maybe, that we can create a reference there instead of repeating the thing. There is an anonymous attendee. May I request all anonymous attendees to kindly rename themselves and put their actual name or their institution name. The Takaful structure should be included in both the standards for proper understanding of readers who sometimes may not have complete understanding of how the structure works. We have seen this issue, especially dealing with auditors as well as regulators outside of Bahrain. To be honest, it's an excellent comment, and I'm afraid about this thing, but this thing can be resolved. So now what we can take, and now we have received several comments, and I think there are two solutions. Either we repeat this structure in both of the standards, or we put it in one of the standards, but we put a reference in the other standard to that, so that the other standard is taken. Let me ask another question as well. When we were doing this project, there was an argument that both of the things should be in one single standard. This was an argument in the working group that instead of developing two standards, we develop only one standard. Earlier, there were 4 standards. To be honest, it was divided in 4 standards: 1 general presentation and disclosure, and 3 standards were considering different aspects of the accounting recognition and measurement part. So from that perspective, this was also a question, either we put all of it in one standard. Putting all of it in one standard might be very difficult. To be honest, it will become a very, very large standard, and finding the appropriate things and finding appropriate references might not be easy. That is one part. There is another question that we discussed, that in the recognition and measurement standard, there is last part related to that it is not equivalent to IFRS 17. Our recognition and measurement standard is equivalent to IFRS 17, but its last part is not equivalent to IFRS 17. Rather, that last part is more related to the specific treatments related to Takaful, particularly with regard to the transactions between the 3 funds, the PTF, the shareholders fund, and the PIF. So that is also one question where you can kindly provide us some comments as to whether you believe that the last section of that standard should remain with the second standard, or we combine all of them as a single standard. So should it be one standard, two standards like they are right now, or should there be three standards? So again, this is a question from the general perspective of a reader. If we can get some comments from you, it will be quite helpful for us to make a final decision, because it was a discussion point at the working group and at the board, and we decided that we'll be finalizing this issue towards the end. So if we get some comments, it is very good. So generally what I can see that people are saying that we should create a reference between the two. That is the structure should be in one standard, but there should be a reference in the other one. But should it be in the first one or in the second one? That still remains a question. There can be one approach of putting it in the general presentation and disclosure standard, and then the accounting standard makes a reference to that, the recognition and measurement standard. But this is a more sense that we put it at one place, not two places. Generally, I'm getting comments of maintaining two standards. There is one comment from Brother Eliezer that in general, there should be one major standard with sub-standards. So again, that is the approach that we are doing. So general presentation standard is the main standard, and then there are additional standards added. This was done in past, so it's okay then. But in that situation, we can have even three instead of two. Thank you very much, brother. The anonymous attendee has a question. Assalamu alaikum. Yes, we have a Sharia standard. Actually, we have two Sharia standards, one on Takaful and one on re-Takaful. So two standards are available already. We are not in a there is no recent plan to revise the standards. Brother Majd, I'm receiving some comments in Arabic. You know, my Arabic is quite weak, brother, so if I do a mistake, please correct that.
There is another. No, you answered the question properly, but there is another question.
I just saw it. الوكالة بأجل هل يقصد بها نسبة المصروفات العمومية والإدارية التي يأخذها الوكيل كنسبة من الإيرادات.
Does we mean by that general expenses and admin expenses related as part of the revenues or related to revenues?
Okay, this is a very good question. Actually, as of now, we said that these expenses are all to be taken care of, including the commission expense by the wakala fee. This is what we are saying right now. However, the Sharia committee had a comment, and that comment is that according to our Sharia standard, the commission expense may be out of wakala as well, which means that the commission expense may be directly charged to the PTF. This is one comment, brother. Let me explain it in English, then you can explain in Arabic as well. So sure. Right now the standard says that wakala fee will take care of all expenses, including the commission expense. Okay. Sharia standard allows commission expense to be charged to the PTF directly, which means that wakala fee has to take care of expenses other than commission. Now, from the regulator's perspective and from the fair accounting perspective, we believe that the commission should be out of wakala fee, not out of the PTF, because there will be inconsistencies and unfair treatments. So it is also a question that all of you can provide us comments either in the chat box, or you can send comments in writing. What you believe with regard to the commission expense, should it be charged to PTF, or should the wakala fee be enhanced and the commission expense taken care of by the wakil? However, we have both options right now under discussion. The Sharia committee has made their comment as well, so we will be considering that. Brother Majd, if you can explain it in Arabic in writing, or you want to explain? I think you can explain for the Arabic audience. It will be good.
I'll drop it. I'll drop my comment just right next to the question. by the جهاز القومي للرقابة على التأمين مراقب التأمين. I'll drop my answer here. Okay.
Okay. So you are writing the answer. What I explained, you are writing it in Arabic in a summary form. Okay, that's also good, brother.
Sure.
Okay, so let's move ahead. So this standard, the preface, the general discussion I have mentioned already. I think in the introduction, I will not go for even all the introduction detail, but I would suggest I will go for one main thing, that is the significant changes part. There are so many changes. So these significant changes may not include all the significant changes, but still it is good to go through these significant changes. So we are talking about the changes that this standard is bringing in as compared to the earlier FAS 12. And what this standard is bringing in, some of those things are coming up from the FAS 1 as well. Like, for example, the other comprehensive income concept and other things, these are brought in by the new framework and new FAS 1 in line with the IFRS, which were not there in our earlier standards. So this standard brings significant changes in the following aspect particularly. The presentation and disclosure. First thing, let me mention, earlier the term was Islamic insurance. Now we are using the term Takaful. Sister Noof, Sister Hora, please note it down. Sister Farida, I think we discussed it earlier as well, that we need to define this as a significant difference, that the term is Takaful, not Islamic insurance. We are conscious about it because there are certain models of Islamic insurance, like a cooperative insurance model, which is not in line with the OAIFI Sharia standard. We are not here to say that, okay, it is not Sharia compliant. Okay, it's up to you to determine whether you consider it Sharia compliant or not, in line with the view of your respected scholars. Same applies to the newly emerging Tafsir model, that we believe that it's not in line with the OAIFI Sharia standard. And we believe that OAIFI Sharia standards are the best consensus-based views with regard to Sharia principles and rules. But again, if you follow some scholars who consider those models acceptable, we are not going to say that it's not Sharia compliant, but this is not in line with the OAIFI Sharia standards. So our model of accounting does not cover them. That's what we want to emphasize. The presentation and disclosure in the standard have been aligned with the Sharia principles and rules related to Takaful, whereby the Takaful institution operator is distinct from the participant funds, including participants Takaful fund and participants investment fund. The PTF and PIF are considered to be off-balance sheet assets under management, therefore separate from Takaful institution. Let me clarify one more thing. The PIF treatment was not covered in the last standard. I think there are some other major important changes, Sister Farida and Brother Harun, which we have discussed. The PIF treatment was not there in the earlier standard. Our earlier standard was more focused on general Takaful. It was not considering so many important aspects of family Takaful or life Takaful, including particularly the PIF element. The PIF, that is the participants investment fund element, which applies normally, for example, in case of unit linked, etc., in case of family Takaful, or what we call individual life policies. So this is actually a new significant addition to our new standards, because earlier these were not cleared for these were not covered very properly. PTF and PIF are considered to be off-balance sheet assets. Statements for the managed PTF and the managed PIF have been introduced, some of which were not part of earlier FAS, including a separate statement of financial statements for managed PTF. Earlier, the PTF statement was there, but so it was like that the PTF revenue account or the PTF income and expenditure was separate from the income and expenditure account of the operator, that is the Takaful institution, but the balance sheet was consolidated. In some of the companies that follow OAIFI standards, we found that they were actually giving two columns. We believe that even two columns are not the best solution. The best solution is to identify PTF separately, because the relationship between the PTF and PIF is the management, and according to the AAOIFI's framework, the control does not exist. For the purpose of having control, we have a definition which is quite similar to the IFRS definition, which means that you must have the control. You have the control if you have, number one, the governance rights. Number two, the governance rights are used to are exercisable for creating variable return to you, and variable return includes profits as well as losses. Considering these situations, we believe that the PTF and PIF both are not controlled by the operator or the institution. Rather, those are managed, not controlled but managed under a fiduciary capacity, and that is the reason that we actually consider it separately. Sister Noof, I just noted that there are some of the working group and board members who are part of the participants today. So check with them if they want to contribute something. You can include them in the panelists. It's a long session and there are a lot of things that I may miss out. And if they want to add something, I saw Brother Irshad and Brother Kashif Siddiqui. And so if you can check with the senior members of the working group and the members of the board, if they want to be part of, particularly the chairman of the working group, if they want to be part of the discussions, so if you can kindly upgrade them to the panelists. Okay, so we have a few QAs. There are a few things in the chat window, but to be honest, I'm not able to see the chat window every time because there are a lot of general discussion there as well. With regard to the question,
Brother Omar, there is one question or comment in Arabic by Ustaz Dr. Abdurrahman Sinusi.
In the chat window? In the chat window,
he suggests
request this thing in Arabic as well, that everybody, if they can kindly put questions in the QA tab as well. If you can request everybody, that will be good.
Yeah. So it says here that why don't we consider zakah on surpluses and technical reserves for or held by Takaful entities?
It's a very good question, and it's not, but it is not a subject of, our this standard, rather it is a subject of our zakah standard. We are working on the zakah guidelines right now. So what we suggest, Brother Mike, that we take this question to the zakah guidelines. We cannot address it here because it will not be subject to this.
Yes,
now, let me put a quick answer to that. We are considering here only Wakala model and Wakala Waqf model. In the Wakala model, you do a tabarro. When you do a tabarro, that tabarro means that the things go out of your ownership. When it goes out of your ownership, the surplus may come back to you, or to one person, or to all different persons. But the question is, it is not guaranteed as to when and how this surplus will be given back to them, and it is not given to one person only. So if we go for khalta or musha, we can say, okay, this is the fund which is related to these guys and it has to be reverted back to them, so it is subject to zakah. But this is not the consensus argument, because a lot of scholars would say that the khalta and musha may not be applicable here. If the khalta and musha is not applicable here, then in that situation, zakah will not be applicable. Similarly, if we take the argument that this amount is not yet decided to be paid to different individuals, and if it does not, because it went out of their ownership when they made the tabarruk, so till the time that surplus is not given back to them, it will not be subject to this. So this applies to Wakala model. Now let me take you to Wakala Waqf model. The Wakala Waqf model was created to resolve some of the issues which are there in the Wakala model, which include the inheritance and zakah issue as well. So if we apply the Wakala Waqf model, then technically speaking, this surplus relates to the Waqf and not to the participants. Waqf can distribute it as a benefit, but Waqf, it is not a mandatory thing to distribute. Waqf can use it for other purposes as well. So in case of Waqf, the zakah will not apply at all. In case of Wakala model, yes, there can be arguments both ways. So those scholars who say that this surplus relates to the participants and must be paid to the participants, and those who believe in khalta and musha to be zakat to be applied based on khalta or musha, in those situations this will be subject to zakat. But in all other situations, it will not be subject to zakah. So generally speaking, we are taking the view that it is not subject to zakah. However, we will cover this specific aspect in the zakah standard. Vedamaj, I don't know whether you need to translate it into Arabic or you can provide the comment to our brother separately.
I will, while you are resuming the discussion, I will drop a comment.
Okay, okay. This will save time for everybody.
Yes.
Bismillahirrahmanirrahim. My name is Askar from Germany. I have a general question for the area of this implementation of this law. It is also for European countries as well?
Sir, the quick answer is that it is subject to adoption by the regulators. What we do is applicable to all over the world. But the point is that if the relevant regulators do not adopt it, then the Islamic financial institutions or Takaful entities may not be able to apply it by themselves. So they are stuck. So there are a large number of regulators around the globe who follow our standards or who adopted our standards either fully or partially or as guidelines. So in the European countries, as of now, our standards are not applicable, although we have seen some of the institutions partially adopting some of our standards, particularly the Sharia standards on a voluntary basis. But applying the financial accounting standards without the regulatory permissions is not easy. So this is something where a lot of differences of opinion may exist, because if you want to apply IFRS, there are certain Sharia non-compliances that you will see during today's presentation, and you might already have read this standard. So in a nutshell, on the accounting side, it is applicable all over the world, but making it implementable needs the regulatory requirements, which might not be there in all the cases, not even in the Western world. Rather, in some of the Muslim countries, still our standards are not adopted. So this is a ground reality. When we develop, we consider it for across the globe, but when it is implemented, the regulatory issue is there.
That is exactly the right time to design it when we are in regulations. Then we should take care about the regulation from, we are in Germany, and I have already established one company in the name of Sharia Investment. So it is in development, and there are some questions from the authorities. So my question is that if we work together, keeping in mind the inquiries from the government of Germany, so we will put it, and then automatically it will be a final law and decision which we can implement here after all.
Sir, we try to collaborate with the regulators around the globe, and to be honest, we are in contact with around 100 regulators around the globe, and we invite them to these events. We invite them to our working groups and other roundtables, etc. as well. For Takaful, we conducted a roundtable for the regulators as well. I think 35 plus regulators were there. Actually, with the regulators in Germany, we have been in contact as well, if I'm not mistaken. But the point is that the significance of Islamic finance in some of these countries is not that much. Like in UK, it's quite irrelevant. So even the Bank of England has a proper desk for that. Where Germany, I believe that is part of the German regulator is part of IFSB, not AOIFI. They're part of IFSB, and they're working on. They were part of, I think, one of the working groups for IFSB, for joint working group for IFSB and AOIFI as well. But other than that, we have seen them representing in some of the forums, but as of now, they don't have any regulations. To be honest, for these countries, the only possible, not only for these countries, for most of the countries, it might not be easy to develop all the regulations by themselves. The best form is adoption of standards. So actually, the industry in those countries should talk to the regulators for adoption of IFSB and AOIFI standards. That is the only solution, because if you ask them to develop regulations specific to them, it might not be within their capacity, and your size might not be that much that you can get it justified. But the main argument can be that you can talk to them that there are two international standard setting bodies, namely IFSB and AOFI, who are developing top quality global standards for regulatory, prudential, solvency, accounting, auditing, governance, ethics, all these areas. So the easiest and the most practical form is that the industry in every country, particularly in the Western world, they need to talk to the regulators for adoption of standards. That's the only solution. When you get those standards as part of regulations, your most of the issues will be resolved. But if if these regulators insist on developing regulations by themselves, then the capacity issue is there. They may not have the capacity, and the size of the industry in those countries is not that big that they can justify significant cost being incurred on those areas. And there is no, actually, to be honest, there is no benefit of reinventing the wheel if global top quality standards are available. So it's not because I'm sitting at AOFI, but even as a journal, when I used to be a consultant, my journal view was that for the regulators, the best approach is to adopt global standards. This makes sure that they get the maximum benefit of these things without any cost. To be honest, for regulators, adopting the standards is no cost, and developing the regulation by themselves is a huge cost, and even for that they may not have capacity. So that is the only solution. So yes, we are open to take comments from all regulators. We are willing to take those regulators on board. We are inviting them to our public hearings, our roundtables, and even in our working groups, etc. We are trying to do our part for interacting with them. But for them, the solution is only one. There are free of cost standards available, which are developed and by top quality professionals, which are available in which are already applied in multiple jurisdictions. So for them, this is the solution. So yes, we are open for any additional collaboration that is needed, and we urge the industry in all parts of the world to focus on one thing. They need to request their regulators for adoption of standards. Not only AOFI standards, I would equally I'd consider significance of IFSB standards, because their area is equally important for that purpose.
Thank you very much. Do you have any institute working with German government or in German business community?
No, our respective department has collaborated with on some of the matters, like has communicated. I would say there is no formal collaboration as yet, but we have communicated with the German regulators. Further details can be provided to you individually, because I think we are going off track from today's discussion. So I would suggest you can drop us an email, and we can discuss it further offline. Our respective department will contact you, inshallah.
Thank you. You must have my email address as I am registered.
Sure.
Should I?
Sister Farida and Sister Noof, please forward our brother Ali Asghar's contact details to brother Rizwan Malik and Sayyid Siddiq. We will coordinate a meeting with him, inshallah, to find out what needs to be done for the purpose of collaboration with regulators in Germany, inshallah.
Yes, inshallah. Thank you.
Thank you very much.
Thank you, brother Ali Asghar. Thank you very much. So we have brother Maj, you are typing an answer to one of the comments. So every time that comment comes back again, so you need to complete typing the answer and close it. There is
in the chat.
Yeah, in the question and answer window, there is one question which I cannot close because it's appearing as you are typing an answer.
Actually, I did it already.
Okay.
I don't know what's wrong. Maybe there is like a technical glitch.
Okay. I closed it.
Okay.
Okay. There is a comment from brother Muhammad Saifullah Azad. Assalamu alaikum. Very effective and valuable discussion. Thank you very much, brother. So, okay, this was not a comment. It was just your appreciation. Thank you very much, brother. That your presence and your comments are the appreciating factor for us. Thank you very much. Assalamu alaikum. Okay, so let's move ahead. Disclosure for Zakah funds and Qard funds have been relocated to the notes. This is done in line with FAS 1. FAS 1 also, because earlier there was Zakah, charity, and Qard funds were primary statements. And when we developed the FAS 1, it was decided that Zakat, charity, and Khalq fund should become disclosures, significant disclosures, but not primary statements. So this is done. Brother Harun, I think, Brother Harun, if you can make note of it, the significant changes list need to be enhanced to identify additional elements which are there, as we discussed. New definitions for Takaful, Takaful institution, Takaful operator, PIF, and the PTF have been introduced. Sister Farida, after PIF, there is a comma, just
Yes.
for consistency purpose. Not only here, this is a continuous issue in certain places. So before export draft is finalized, please resolve this issue.
Inshallah.
A standard has been aligned with FAS 1 revised 2020 because we actually, it is FAS 1 revised 2020 or revised 2021?
It's now revised 2021.
Okay, just keep a note of it.
And we put the full name. Inshallah, we'll put the full name because now it's issued.
Yeah. So put the full name. Okay.
Yes.
Thank you. Okay, so we come to the objective of the standard. The objective of this standard is to set out the overall requirements for presentation and of financial statements, the minimum requirements for the content of and disclosures in the financial statements, and a recommended model of financial statements that facilitates faithful presentation in line with Sharia principles and rules for Takaful institutions. The standard is applicable to all Takaful institutions regardless of their legal form or size, including Takaful window operations. This standard is applicable to the Takaful institutions while presenting consolidated financial statements as well as the standalone or separate financial statements. The standard does not apply to the structure and content of condensed or summarized financial reports prepared for the interim financial report. The standard should be read in conjunction with the requirements of Part 1 applicable to all financial institutions of Phase 1, general presentation and disclosure, that is, the name needs to be revised, whereby the requirements of the standard shall be considered in addition to the requirements prescribed therein with regard to the general presentation and disclosures in the financial statements of all Islamic financial institutions. The requirements of this standard shall, however, apply in case of a conflict between the requirements of the two standards. Just one thing, Sister Farida.
Yes, brother.
Normally with the contents, we put a box, and that box identifies that this standard needs to be read with the in line with the relevant Sharia standard. That is a standard box that is there. But just make a note of this point. We need to discuss it in the working group whether we need to put that requirement of only Wakala model or the acceptable model in the scope as well.
Okay.
Just make a note of it. I think we discussed it earlier as well, but just make a note of it. We don't need to miss it out. So that whether the scope should clearly identify, but we are very clear. The box is not reproduced here. That one is in with the after the end of the content. So that box is not reproduced here. I would suggest that in future, please always reproduce that box also in the
body text, main body text,
in the presentations, not in the body text. For this standard, we may need to put the scoping part. But for all standards, when you prepare the presentations, please put that box in the presentation.
Okay, got it.
Okay, now coming to the definitions. Owner's equity is the residual interest in the assets of the institution after deducting all the liabilities and the quasi-equity. Explanation. In the context of Takaful institutions, it represents only the equity related to Takaful operator oblique shareholders. Participants also referred to as policyholders investment fund. PIF is the fund. I think PIF and PTF the definitions are improved in the second standard. Yes, I think so.
Yes, it's slightly improved in the second one.
Yeah, slightly improved. So I'll let me read them, and when we reach there, I'll identify the difference. PIF is the fund managed by the Takaful institution on behalf of participants collectively with the objective of making investment and earning returns thereon based on Mudarba or Al-Wakala bil Istismar. Let me clarify one very important thing. There can be some investment in the PTF also. Means that, for example, if I'm a general Takaful company and I get the contribution, so I get that some cash flow in the beginning of the year, and then I invest that in some investment opportunities. This is the investment of the PTF. The PIF applies only in family Takaful business where we have a unit linked or other type of investment fund. So we should not be mixing up PIF with the investment within PTF. So there can be investment within PTF as well. But the PIF or Participants Investment Fund is actually the unit linked or other fund. Let me clarify one thing. At times we feel that we are ahead of the conventional world already. Now with IFRS 17, the conventional insurance companies are required to segregate the investment element and show it separately. We were already doing that. To be honest, we were already doing that. But yes, we were not doing it in the contribution. We were allocating it out of the contribution. Now it cannot be taken to the overall revenue as well. So we need to consider that part as well. But other than that, the investment component to be shown separately was not a requirement under conventional, but we already had this requirement. But now we have clarified it, and this is also aligned with IFRS 17. Participants Takaful Fund, it is participants, again, one thing, in some parts of the world, the term participant is not prevalent and the policyholder term is used. While policyholder term is a conventional term, and it may be well understood by the market participant generally, but we believe that the participant in terms of Takaful, participant is the more appropriate term. Again, some of the regulators have used the term participant. So we decided to use the term participants, not the policyholders, but only in the definition we mentioned that it is also referred to as policyholders in different parts of the world. PTF is the fund created by the participants with the objective of sharing risk, whose management has been undertaken by the Takaful institution. The fund is entitled to the contributions and returns, is subject to direct expenses, provisions, and reserves related to Takaful operations and the surplus or deficit arising thereon. Qard, also referred to as Qard Hasan, is an interest-free loan intended to allow the borrower to use the loan funds with or without prescribing a period of time, with the understanding that the same amount of the loan fund in the original nature of fund, for example, same currency, would be repaid when due or when demanded in case of period is not prescribed. Explanation. In the special context of this standard, it refers to the interest-free loan extended by the Takaful operator to the PTF to temporarily fund the deficit in the PTF. We have one QA here. في صيغة المضاربة هل يمكن تقديم ضمانات للترتيب والتقصير من المضارب حفاظا لحقوق حملة الوسائل? Sir, this point, brother Majd, I think this point is a mudarba issue and not a issue for us right now. This, and secondly, it's not an accounting issue; it's a Sharia issue. Yes. So I'll prefer not to answer this now. Our Sharia standard generally believes that yes, partial guarantee with regard to these elements is acceptable. But I would not like to go into detail for this one right now. First, because it's a Sharia issue. Second, it's a mudarba issue and not a subject of this standard particularly. Reinsurance is a convention. Okay, reinsurance and retakaful, I'll read from the new one because the standard, the policies, these definitions are updated. So when we reach there, I'll read them from the second standard. And Sister Farida, please note it down that in the first standard, we need to align them with the second standard.
Yes.
Takaful is also slightly improved, but let me read because it's very important to understand this standard as well. Or maybe either I take you to the other standard now. The second approach is let me take you to these definitions from the other standard. Okay, so let me take you to the definitions, two definitions or three definitions which are updated here. Reinsurance. Reinsurance is more or less the same and is coming from the Sharia standard. Reinsurance is a conventional contract. Sorry, it's not coming from Sharia standard, but it was similar to that. It's a conventional contract according to which an insurance company cedes, transfers part of the risk to its insurance commitments to a reinsurance company. The insurance company therefore undertakes to pay the reinsurance company part of the insurance premium paid by the policyholders against commitment of the reinsurance company to bear part of the claims as per the agreement between the two parties. Takaful refers to the arrangement among Takaful institutions on behalf of their respective PTFs under management to devise a mechanism for the avoidance of part of risk which the PTF may encounter. On the basis of such arrangement, a Takaful PTF, which has a distinct juristic personality and the independent financial liability, is formed through making contributions out of the PTFs as a part of the contributions paid by their respective participants on the basis of tabarruk. The Takaful PTF thus formed assumes the task of covering part of the risk encountered by the PTFs. Explanation. Takaful is the Sharia compliant alternative to the conventional insurance contract. Let me make it bigger. Sorry. Explanation. Takaful is the Sharia compliant alternative to the conventional reinsurance, having the distinctive characteristics of being based on the same principles of Takaful and mutuality as indicated in SS 26, Sharia Standard 26 Islamic Insurance, and Sharia Standard 41 Islamic Reinsurance, instead of exchange of reinsurance premiums. The need for Takaful may arise in respect of a Takaful institution due to lack of sufficient capacity to take risks or because of regulatory requirements of risk sharing with regard to the magnitude of the risk in question. Note, for the purpose of this standard, the term Takaful, wherever the context suggests, may include conventional reinsurance in line with the prevailing practices of the Takaful institution in case of dire need, subject to Sharia principles and rules, with adequate disclosures in respect of the same. Let me take the Takaful definition from here also. I think, yes. Takaful is a process of agreement among a group of persons to handle the losses resulting from a specific risk to which all of them are vulnerable. A process thus initiated involves payment of contributions and donations and leads to the establishment of a Takaful fund that enjoys the status of a legal entity from Sharia perspective and has independent financial liability. The resources, Sister Farida, please note it down. In the Takaful, it's juristic person, and here is a legal entity. Juristic entity. So we just need to align the two. Okay. The resources of this fund are used to indemnify any participant who encounters injury subject to a specific set of rules and given process of documentation. The fund is managed by either a selected group of participants or a joint stock company that manages the Takaful operation and invests in the assets of the fund for an agreed fee. With that, we'll go back to our definitions from the first standard. These three definitions I brought you here because these were the updated ones. So let's move back to where we were. Takaful institution is an entity possessing the license of practicing Takaful, at times referred to as an Islamic insurance business, in line with the requirements of Sharia principles and rules. The institution undertakes its operation based on a remunerated wakala agency agreement or contract. In addition to managing the Takaful operation, the institution also assumes the responsibility of investing the assets of the fund through Mudarba or investment agency. Explanation. For the purpose of this standard, a Takaful institution includes a Takaful window operation. The notion Takaful institution, unless the context suggests otherwise, includes the Takaful operator and the participant fund. Let me clarify one issue here, which we have received in some of the questions. So if you see the footnote here, Takaful window operation shall apply this standard in conjunction with the requirements of FAS 18, particularly paragraph this. Now this FAS 18 has been revised also, and we have FAS 41 for Windows, Sister Farida. It's 40 or 41? The new Windows
40,
standard?
40,
40, FAS 40. So the new FAS 40, so we will change in the final version of this standard. This footnote reference will be changed. Sister Farida, please make a note of it, including the updated paragraph numbers. Now, what will happen? Some people asked us this question about the windows. that how to consolidate and how to show it. Our conclusion is that Takaful business and insurance business are different. Insurance business is sale and transfer of risk, while Takaful business is management of a shared risk business. So these are completely different things. So you cannot just add the line items. So even for the purpose of banking and other type of Islamic financial institution, the new window standard is very clear. It says that you need to have a proper full set of the financial statements of the window, which means that window must keep proper full records of financial statements according to and prepare financial statements according to this standard. And disclosures, either preferred is that there should be a full set of financial statements attached, because we believe that a window is an institution within an institution. You cannot just have a single product. So actually we disallowed in this standard, as well as the joint Sharia governance framework that is coming from IFSB and AAOIFI, we believe that just offering of a product by a conventional institution is not encouraged. So technically speaking, we are saying that there must be either a license window or a virtual window, and that license window or virtual window must keep all finances, investments, and even accounting records separate from the conventional one. It must prepare a full set of financial statements according to this standard. So a window, as we clarified here, that for the purpose of the standard, a Takaful institution includes a window, which means that window has to prepare a full set of financial statements. Takaful operator in the specific context of this standard represents the function of Takaful institution, whereby it manages the PTF and the PIF, and from accounting perspective represents the residual part of the Takaful institution duly owned by and representing the equity rights and obligations of the shareholders or the principal owners of the Takaful institution, excluding the PTF and PIF. Any comments on these definitions? What time we are supposed to take a break? At 12, 11 or 11:30?
11:50.
Okay, we'll try to complete this part of the standard and then take the break. This standard, the first standard, and then take the break. Okay, complete set of financial statements. The complete set of financial statements of the Takaful institution include so many primary statements. Now the question is, why there are so many primary statements? Can't we reduce them? We tried to reduce them only to one extent, and we reduced it for one statement at least. I'll mention that to you. But the point is, Takaful is a complex business. It's not a single entity. There are multiple virtual entities which are there. So combining it all together in one single statement might not reflect the true nature of Takaful, and that is the reason that we have required multiple statements. So the first statement is the SFP, the statement of financial position or balance sheet of the institution. That is only the shareholder part or the operator part. It is not consolidated. It's not including the PIF and PTF. Statement of income and other comprehensive income of the Takaful institution. According to phase 1, there can be two statements. A statement of income can be separate and other comprehensive income can be separate, but we preferred to keep it one, because already there are so many statements. So that was a suggestion, but again, it is allowed to keep it two. Statement of change in owner's equity of the Takaful institution. So this is the third statement. The fourth statement is a statement of cash flows of the Takaful institution. So the set of Takaful operators financial statements is a complete four statement set, that is balance sheet, income statement or P&L, with the other comprehensive statement, the statement of change in equity and the cash flows. So these A, B, C, D apply only to the institution or the operator, that is the shareholder part. It does not include any of the other elements. Now, E, a statement of financial position of managed PTF separately for the general and family operations at the end of the reporting period, and a statement of financial activities for managed PTF separately for general and family operations for the financial reporting period. Now, what happens that the income statement of managed PTF we changed it to statement of financial activities because we believe that this is the PTF is a not-for-profit entity, and for not-for-profit entity, the statement of financial activities is a better term than the income and other comprehensive income statement. So we decided to put in the statement of financial activities. Second thing, as I mentioned in E, we segregated the balance sheet of PTF from the balance sheet of the overall institution. Our existing standard is actually having a consolidated statement, which we believe is not aligned with the new framework. The new framework has emphasized significantly on the definition of control, and the managed funds are identified separately. We believe that keeping it as a simple statement, single statement, was primarily for the purpose of ease of reporting by keeping the reports separately, because even the earlier standard had that distinction between the PTF and the operator fund. But we believe that if you keep the income statement separate, you should also keep the balance sheet separate. So this is something which actually comes in form of a new statement. Normally, in most parts of the world, the general insurance companies and general Takaful companies and family Takaful or life Takaful companies are separate. In most parts of the world, this is a requirement that the companies are there. But again, there are different parts of the world where one insurance entity has the general and the family both businesses. We believe that the general and family businesses may actually be even following two different accounting policies as well. Like, for example, when we go to the detailed one, it can be even following a simplified model versus the general model. So there can be differences, and even the nature of the risk that the two businesses carry are different. So we have required these statements to be separate for general business and the family business. There can be some companies in the GCC. We believe there are some companies who are doing both businesses under the same company as well, and there are some other parts of the world. But and also on a consolidated basis, it will become a question everywhere that there will be consolidating entities where the both businesses are existing. But for the purpose of reflecting the nature of the risks by both businesses, we have put the disclosure, the requirement of keeping the financial statement of financial position and the statement of financial activities separate for both of them. And as I mentioned, it can even require separate accounting policies, etc. as well. This we will discuss in the second standard. Statement of managed PIF. Now, in the case of a statement of managed PIF, we did not require a balance sheet and income statement or a statement of financial activities separately. Rather, we in line with what we have required for the banks in case of managed RIA accounts or managed off balance sheet managed assets, we allowed a single statement. Allowing a single statement means that the overall activity can be put in single statement rather than having a separate balance sheet or income statement. So it starts with the opening balance and shows the movement as well as profits and losses during the period, and ends with the closing balance. So this is something that is here. I was saying that we saved at least one statement here. We also saved two more statements. That is the statement of Qard fund and statement of Zakah and charity fund. So we saved those as primary statement as well, because we believe that those are important disclosures but are not primary financial statements. So it was decided to move them to the notes. So yes, there are a lot of primary statements here. And to be honest, a lot of people still feel that insurance accounting is complicated and Takaful accounting is even more complicated. Even a common man may not easily read the financial statements. But we believe that this is the minimum requirement to reflect the true performance status, state of affairs and operations and financial activities of the Takaful institution as a whole. PIF statement will not be applicable mostly on, I think not mostly, but rather on all of the general Takaful entities. On life Takaful entities, PIF statement will become applicable mostly in case of individual life where there is an investment component. Other than that, on an overall basis, the other requirements of phase 1 with regard to general disclosure, etc., will also be applicable. I think we have one question in and one comment by Brother Mohammed Saful Azad. Under complete set of financial statement, is there any need of cash flow statement? Yes, cash flow statement of the shareholders is still there. We still believe that the cash flow statement is important, and cash flow statement reflects some very important information which is not available for the users from the balance sheet and income statement only. So we believe that statement of cash flows is important. However, we believe that statement of cash flows is primarily important for the shareholder part and not equally important for the PTF or PIF part. The PIF, we have a statement of managed PTF which provides most of the information directly. So that is like, you know, there is no need for adding multiple statements for PIF. For the PTF, we would love to have comments from the participants right now, or you can send in writing later as well. Let me ask the participants, how many of you feel that it's important to have a cash flow statement for the PTF? I personally believe that the PTF statement, the financial activities statement, reflects most of the necessary information directly. So you don't need a cash flow statement for PTF. But if you feel that there is a need for cash flow statement for PTF, please put your comments in the Q&A box. We will highly appreciate that. With regard to the cash flow statement for the shareholders, I believe that like our framework and IFRS framework and the requirements of our FAS 1 and IS 1 and IS 7, we believe that cash flow statement is very important for understanding the performance and the cash flows and the valuation of the Takaful entity from the perspective of the investors of the Takaful entity. So that for that purpose, cash flow is very, very important, like any other entity.
Brother Umar, we have Brother Kashif has put a comment, but it's in the chat actually. It's not in the Q&A.
Brother Kashif, Brother Kashif is a learned guy. We should ask him to put it in the Q&A box. No problem. Brother Kashif is very, very respectful for us. So even if it is in the chat box, I'm answering. But just in order to make sure that we don't miss out anything, please put all the comments in the Q&A box. It is also important because we can take these comments, because we cannot take or record of all of the whatever is in the chat box. But we take whatever in the Q&A box directly to the comments in the standard. So that actually saves time and effort for us and ensures that we don't miss out anything. Do we need to define the general and family operation where we are asking for separate reporting? Medical operation may be written in both general and family. Sometimes its reporting is defined under the regulations of different jurisdictions. Very good point, Brother Kashif. To be honest, it's a very good point. Brother Kashif is saying that as a panelist, I cannot put Q&A. So I think we need to put a complaint to Zoom.
To Zoom, yes.
Yeah. Again, thank you, Brother Kashif, but you can speak up then. Making you panelist means that you can speak up. So it's a very valid point, Brother Kashif. So first point, let's define the family and general operations. This is one thing that we need to define that. Secondly, yes, we understand particularly the healthcare business, the healthcare insurance or the health insurance is at times in both. And actually, I have seen some part of group life in general as well. Those are, I have seen some part of group life in general in form of credit insurance. I have seen that general insurance was ensuring credit that in case of death of the debtor, the bank will be paid by the insurance company. I think I saw it in one of the journal companies. Similarly, I have seen even travel in both. The travel life insurance I have seen in both, if I'm not mistaken, if I remember correctly. So yes, but particularly the medical insurance or the healthcare insurance, for sure in different parts of the world it is there, and at times it is there by both. So Brother Kashif, it's a very good point. Sister Farida, please make a note. Number one, when we mention that two different are needed, we must define the general and family. Either it should be a full definition, or at least in the footnote we should define, but it is a very important point. Similarly, now there is one question coming to my mind, Brother Kashif, a different point, and you can open up your mic and speak on that as well. Would it be appropriate, because one of the important characteristics of financial statements is comparability. So if one Takaful company, for example, I know one Takaful company in Pakistan that was doing healthcare, and there was another Takaful company which was not doing healthcare because they had a sister concern as a family Takaful company, and they were not doing healthcare because the healthcare was being done by their sister concern, which is a family Takaful company. So the first company that I'm talking about was not having a family Takaful company, so they were doing healthcare insurance within their general operations. So now, do you think it's a issue of comparability as well?
Thank you, Umar Bhai. Actually, under the IFRS 17, the segregation is not based on the family in general. It is based on the short-term and long-term contracts. So
that is the accounting part, brother. Not required, but they are not requiring two different statements. For the accounting, we still have the short-term and long-term things.
Yeah. For example, in Oman, we have clearly identified the medical as a separate category of the license under the regulations, and also we want to have a separate reporting for regulatory purposes. But for the published financial statement, we ask them to put under general. We have put under the regulation, so that there will be no mismatch, that some company will be reporting on the family and some company will be reporting on the general, because we have composite regime following here in Oman. But in those countries where the regime is totally different, that the life company is different and general company is different, I think there will be no such issue.
Okay, so if it is already defined by the regulator, now the question is, if in the footnote we can say that the definition of general and family can be in line with the definition by the regulator. That is part one. So we don't need to define it. Now the second question: if it is not defined by the regulator, shall we put then instead of general and family, it should be short and long term?
I think it should be short.
Brother, IFRS is not asking separate reporting, financial statement reporting for general and for short term and long term. They are distinguishing for the accounting policy purpose and the reporting and financial reporting and disclosure purpose. But they are not asking two different statements. Here we are asking two different statements. Or we should not ask two different statements. When we ask two different statements, the purpose of asking two different statements was because the risk profile of the two are different, and we should be able to, the user should be able to comprehend those risk profiles. And again, regulator has all the information available through the regulatory reporting. But for a common user, if I put them together in one statement, then the risk profile of both is different. But we can put two approaches. One approach is, in the countries where general and family are defined separately, you make two statements of general and family. In the countries where general and family are not asked separately, you can put two statements of long term and versus short term. Would it be right approach? But again, there will be a comparability issue across the globe. Any other comments? Can we have more comments in the chat Q&A box? Okay, there are 2-3 comments. Brother Abdurrahman Abu Bakr, cash flow is very important for both shareholders and participants. Okay. So your comment is that for participants PTF also we should have cash flow. Okay, let's make a note of it. That one comment at least is there that we should have participants cash flow as well. Brother Sanjeev Agarwal, I believe cash flow statement is important for both participants and shareholders. Okay, so you also have the same view.
By the way, Umar bhai, in the note number 8, it is already mentioned that the cash flow of the financial institutions and the managed funds. So it means it is applied here.
Actually, it applies to present financial position, financial performance, financial activities, and cash flows. So when we said it, then cash flow applies to all, because for PIF we required only one statement, and for PTF we required 2 statements, and for Takaful institution we required 4 statements. So this 8 does not mean that we are asking a cash flows for the PTF, because D applies only on institutions. So actually that is a qualitative explanation. That this is a qualitative explanation. You got my point, but I take a note of your point that 8 needs to be explained properly, because as of now the requirement of cash flow for PTF is not there. So in that situation we should be either we put a requirement or we don't put a requirement. But for PIF again, so brother Kashif, in that situation for the institution there are 4 statements, and it can become 5 if you opt to put OCI and income and expenditure separately. So it can become from 4 to 5 statements actually. So to be honest, I believe that it will be too much that we say 5 statements for Takaful institution, 5 statements for PTF, and 5 statements for PIF. We actually kept it 4 or 5 for PTF for institution, only 2 for PTF, only 1 for PIF. And the purpose was that we did not want to have too many statements. If you get 15 many statements, getting the necessary information will become very difficult.
But I think cash flow, yes, it is necessary for participant fund, but I believe.
Okay, so this is a good point. So you also have a comment. Brother Sanjeev has this comment. So either we say there can be 2 options. Either we say you put one cash flow identifying cash flows for both, or we put a separate cash flow for PTF.
Separate should be more good.
Okay, Brother Sanjeev has a comment that we should be using the term Takaful operator instead of institution. I think it's a good idea. To be honest, I'll myself agree with this idea. Sister Farida, Brother Harun, if you note it down, we need to take it to the working group that in order to avoid the confusion, we use the term institution for everyone combined and operator when we are talking about only the shareholder part. So this way we will have better clarification. So wherever we have used the terms, we need to consider this. So brother Sanjeev has a very good comment. I personally fully agree with this one, that we should be using the term operator instead of institution.
Okay.
Brother Sanjeev is saying that for the cash flow, we give option both or separate. Brother Sanjeev, just one question. If we put both in, as a combined, I'm just thinking, one of the purpose of cash flow statement is to identify the free flow of cash, that how much cash is being generated from operations, etc. Now, what will happen if we put a single cash flow statement? It will reflect the full cash flow, but it will not reflect the free cash flow. Means that what cash flows from operations that are shown might be more related to PTF and maybe in some cases PIF also. If we also decide to keep it a full consolidated, so in that situation that will not be a free flow. Means that cash flow is coming to you, that cash flow is not available for your shareholders. So in that, I'm just thinking again, loud thinking, that even if we put a requirement for cash flow, then it should be a separate one. So what is coming to my mind? For PIF, still a single statement would be enough, I think, because it will show all of the additional investments made, and the encashment and everything will be coming in the movement already. So for PIF, we don't put it, but for PTF, we put cash flow as a requirement. So it will become a third statement for PTF, or we can give it an optional, that cash flow can be provided as an optional, because in depending on some of the needs, actually the cash flow of PTF might still be useful, but it is not freely available to the main shareholders. So putting it on a consolidated basis may incorrectly reflect the situation. Again, we will take the comment to the working group, but we are just doing it. There is a Q&A. How can I have a certification of attendance? We issue the certificate of attendance for need basis, for those who need. You just need to drop an email again to us, and since you are registered, you will get it, inshallah. Okay, thanks, brother Sanjeev. You agreed with my view, so we'll give it either as a mandatory requirement for PTF cash flow, or we can put it as a optional requirement for PTF cash flow. I'm just loud thinking. We'll take it to the working group, and then they will decide. Now, brother Saifullah Azad again has a comment. What are the major changes or developments, if any, from earlier alike standards? Why this standard separately developed? Brother Saifullah, I think I discussed these things, and brother Majd in the beginning actually identified the whole process through which it has gone through, and the reasons and some of the major decisions with regard to that. I would say that this standard was due for revision because it was nearly 20 years old. The FAS 12 is nearly 20 years old. In between, FAS 4 came and superseded by FAS 17. FAS 17 came in. From AAOIFI's perspective, we came up with the new framework and new FAS 1. So from so the other comprehensive income and so many new requirements came in between from IFRS side and from AAOIFI side. So the standard was due for revision. So the second standard is primarily an equivalent to IFRS 17, and this one is a new standard to align the requirements with the new IFRS, new FAS 1, new framework of AAOIFI, etc. Brother Muhammad Jafar Iqbal, IFSB uses the term Takaful undertaking for Takaful institution. This may be considered for consistency purposes. Brother Jafar, let's consider this one, but IFSB also uses the term IIFS, institutions offering Islamic financial services. So that is their primary term. So they also use the term institution. At AAOIFI, we have been using the term IFIs and institution across all standards. So we insisted on Takaful institution, but we'll take a comment from your side. And now the question is it Takaful undertaking term being used for the purpose of operator or for the institution on a combined basis? Can you clarify this part? We will check it with the IFSB standards, but if you can quickly clarify this part, that might be helpful for us, that whether this term Takaful undertaking is being used for the Takaful institution as a whole or for only the operator part. Okay, so you are they are using, in your view, they are using Takaful undertaking, which includes the institution or operator and the PTF and the PIF. Okay, it's a good term actually. Let's consider if it is suitable for us. So we'll see, inshallah. Thank you very much, brother, for very valid and very good comment. Inshallah, we'll consider. Brother Junaid Amanullah, in Takaful model, shall be discounting rate is applicable in line with IFRS 17 or not, since as per my understanding, money is not commodity in Takaful? Brother, it's a very good comment, but if I answer it right now, it will be a bit early. So let me request you to put it as a question again when we reach at the okay, let me keep this question open, and I'll discuss this thing later when we discuss the second standard, which is about the accounting part, because it may be like, you know, jumping to a topic which is where we have not yet reached right now. So I'll discuss this question later. It's a very good question. Thank you for that. Now, presentation and disclosure requirements. These are the general qualitative requirement that they should faithfully presented, and the assets liabilities shall be considered separately. PTF, Takaful operator, and the PIF shall all be kept separate. FAS 1 requirements are to be followed if they are not inconsistent with the requirements of this one. Then on the accounting policies and estimates, whatever are the general accounting policies, etc., which are required, it should be disclosed. Like, for example, the property, plant and equipment and everything which is like, you know, coming from IFRS or FAS 1, those should be covered. But additionally, there are some very specific reporting policies which need to be identified. Segregating, recording and reporting the funds pertaining to managed PTF and PIF separately from operators' funds, recognizing, deferring and amortizing earned contribution, recognizing. Yeah.
From Mr. Jumha, Mr. Said
Sorry, Sister Noof, I couldn't hear you very clearly.
We have two raised hand here from Mr. Atigalla and Mr. Jumha. They raised their hand. Maybe they want to comment or something.
For now, I would request everybody to put the comments in the chat, in the question answer box, because right now I believe we don't have enough time. Okay. So we'll not take the we'll not open up the speakers right now. The mics are right now. Okay. But towards the end, if we have time, we can allow people to speak. But right now, we are getting so many questions in the QA box, and we are already having like, you know, a lot of discussion. These are already quite detailed standards, so maybe we may not be able to open up the mics. Let me see if I'm able to cover this part, and towards the end we can take. In the meanwhile, if you can kindly put your comments in the Q&A box as well, it will be good. Okay, the policy for outstanding claims and claims incurred but not reported, recognizing, deferring and amortizing Takaful business acquisition costs, recognizing commission earned from the Takaful institution, and the CSM. The term CSM here has been used, but the new standard is using the term PRM. Actually, I would say that this accounting policies part will be aligned with the recognition and measurement standard, because some of the terms used in that standard are updated terms. So we'll have to update this one. And I believe that one or two of the accounting policies even need to be aligned with that. So maybe we can consider putting the accounting policy section in one of the standards, not in both of the standards, and putting them at like, you know, after proper alignment with each other. In the QA box, we have some questions again. From the anonymous attendee, how we cover the VFA requirements in our standard. VFA stands for, sorry, kindly pardon me for my ignorance. What is VFA? Can you kindly clarify, brother or sister? Abdurrahman Abu Bakr has a comment. Please, I do also need certificate. Okay, that's about certificate of attendance will be done, but please send an email for that. This chat window is not for that. Variable fee approach for this standard is for the general presentation. Now the variable fee approach for, you are talking about the family takaful or the general takaful? Actually, the point is, if you are talking about the wakala variable fee, it's variable wakala fee. Please clarify me on that. Okay, so this is the wakala element for that, wakala or mudarba element for that. Am I right? Okay. Okay. Actually, we identified the term as with or without incentives. If you see, I have touched upon it as a with or without incentives. Further details about it will go to the second standard, which is about recognition and measurement. And with regard to particularly the last section of the same, actually talks about the fee which is charged to the PTF and the PIF. So when we reach there, I hope you will find an answer to your question by yourself. But if still you need any further clarification, you can discuss. So we talked about, we did not use the term variable fee, rather we use the term wakala fee with or without incentives, which means that it includes the variable element. So I hope that at that point of time, when we reach there, you will find the answer to your question. But still, if you feel a further clarification is needed, or if our wording needs to be improved there, please let us know. But I think it will be better if we discuss it at that point of time. Brother Jafar. Okay, thanks for updating me on this, Brother Jafar Iqbal, about the modification of GMM in IFRS 17 only applicable to life companies. I think our model is different, because in our model the complete segregation is needed, and the complete segregation is needed, which means that the Takaful operator and the Takaful operator has to identify the PIF wakala fee or mudarba fee or wakala bil istismar fee with incentives, etc. separately. So I believe our computation model is slightly different. In IFRS 17, you actually unbundle it. You unbundle the investment product and then you calculate that element separately. So from your perspective, it is from the conventional insurance perspective, that is actually something that you separate. While from the Islamic finance perspective, the PIF agreement is already separate, and that agreement already defines the structure according to which the fee will be charged. So my understanding is that this thing does not apply in the computation element. Sheikh Bilal Al Mullah has said Assalamu alaikum, wa alaikum assalam, sir, and we are honored to have you here. Thank you very much. Accounting for transfers and de-recognitions, accounting for relevant share of Takaful business from co-Takaful arrangements, including the policy to recognize the relevant share of Takaful business from co-insurance arrangements which are not in compliance with Sharia principles and rules, recognizing Qard Hasan and its measurement, including accounting for impairment thereon in the books of the Takaful operator and its contra accounting in the books of the PTF, recognizing income tax, including current and deferred attribution to the managed funds as appropriate, to ensure fair and transparent treatment for different stakeholders, along with necessary explanation of the basis of computation of taxation or any exemption available to the managed funds, recognizing wakala fee and mudarib share for investment management activity where applicable, and their timing and recognition, deferment and amortization in the books of the Takaful operator and its contra accounting in the respective books of PTF and PIF, recognizing and accounting for income gains and losses from investments in line with the relevant FAS, and identifying the differences in classification of investment as applicable in case of managed fund, ensuring avoidance of accounting mismatch. So these are the accounting policies which are minimum required there. The effective date is appearing as 2023. As I mentioned, that probably both of them will, not probably, for sure, both of the standards will have the same application date, and probably the date will be 2024 or maybe 2025. On the transitional provisions, this standard, along with FAS 1 and the accounting for Takaful products, this was the name initially proposed for this one. This will be updated. This is the accounting for Takaful recognition and measurement, the new standard. There might be some significant changes, and in that situation, the transitional provisions are provided in the other standard, not in this standard. But we will align this. We will align this one together, and this standard actually supersedes the earlier standard, general presentation and disclosure in the financial statements of the Islamic insurance companies. So with that, the minimum components are put in the appendix. The decision was that this should be put in the appendix because according to the nature, there may be plus or minus for that. So we have moved this part to the appendix. So it means that these are part of the standard, but there can be some flexibility in the way these are presented. So what are the general requirements are identified in this section B1, 2, 3, 4. The general requirements about the description of the Takaful model and significant terms and of the contracts between the party, the intra-institution, three different funds may have internal contracts like Wakala, Mudarba. So those all contracts and arrangements are to be defined properly. And these are the disclosure requirements. I'm not going to repeat each one of them because these are quite detailed. So, but we are open for taking any comments here. With regard to the most important part is with regard to the important notes, what needs to be there, any important specific requirements, those things are which are required here. I'm not going to go for detail as I mentioned. With regard to the main primary statements, there is a list of the general disclosure requirements, general presentation requirements. So on the statement of financial position, the assets have to include cash and balances, Islamic banks and other financial institutions, deposits with regulators, receivable from managed PTF and managed PIF, person receivable from the managed PTF, net of allowance for impairment of their own, accounts receivable, but accounts receivable here are not to include the contributions receivable. Contributions receivable are part of PTF, not part of the Takaful institution. Investments in associate, joint venture, investment in real estate, investment in sukuk and other shares and others, investment in shares and other securities, PPE, rights of use assets in line with FAS 32, intangible assets, income tax distinguishing between current and deferred tax, and other assets with disclosure of significant types. Then we have, in case of assets, and it's a very rare situation. It's a very rare situation that an Islamic financial, that a Takaful institution may have quasi-equity. That will be normally in case of sukuk, if there are sukuk issued by the Takaful entity. That will be the situation where there can be quasi-equity. The second situation, second rare such situation can be when there is PIF, and the PIF is on an unrestricted basis with commingled funds. This is not common at all in Islamic financial institutions, but if there are bundled policies with the elements equivalent to quasi-equity, so that is considered to be a rare situation where there can be quasi-equity. In that situation, the quasi-equity accounting similar to FAS 27 will be applicable. Then these are the liabilities related to only the Takaful institution's owners due to managed PTF and managed PIF, due to financial institution, due to other counterparties, sukuk liability type, if there are any gross ijara liability, provisions, accruals, and net. Sister Farida, please note it down. I identified this earlier as well. You need to check that it has to be EFGH, okay? Because it's not a subheading of this one.
Okay.
Yeah. It will be first one will be F, and then there will be within that. So this needs to be corrected. There are typo errors here. It needs to be corrected. Then we have quasi-equity. As I mentioned, that if quasi-equity is there, sukuk, financing based on musharaka, mudarba, if any, and investment accounts, if applicable, as I mentioned, very rarely if they are. Owner's equity. Obviously, these are the common owner's equity disclosures include, but this include treasury shares, etc. And then there has to be additional disclosures here. Now we come to statement of income and other comprehensive income of the Takaful institution. So the first is wakala fee and share of profit from Takaful institution for managed PTF and managed PIF, disclosing the manner in which unearned contribution and wakala fee is recognized. Sister Farida, I think this was a comment that wakala fee should be separate and share of profit should be separate. Just note it down. I think we received this comment earlier. Income and gain from participatory investments and investments in shares and other securities. Investment and gain from investment carried at fair value through statement of income. Investment income from off-balance sheet assets under management other than PTF and PIF. Income from associate, other fee, commission and related expenses. Other income, general and admin expenses, etc. Net income before zakah and taxes, income taxes. Zakah applies here, but we have not put zakah on. So we are talking about zakah only related to shareholders and where it is required by law or by the statutory documents of the institution. Otherwise, zakah will go to the statement of change in equity, or there will be only disclosure of zakah. But according to our new zakah standard, at least a disclosure of zakah computation is a must. So net income and then other comprehensive income. I think Sister Farida, please know it was also discussed that other comprehensive income subcomponents are not missing. Are missing here.
Okay.
Okay. What are the subcomponents of other comprehensive income? They are missing. Okay.
Okay.
Okay. Then we talked about zakah. Then coming to statement of changes in equity of the institution, that is the operator. So this is the common this is the common disclosures which are there for the statement of change in equity. Then a statement of cash flow for the Takaful institution. This is now I recall this one. We did not require a full cash flow, but we required appropriate disclosures shall be provided as a footnote to the Sister Farida, two is missing here, to the statement of cash flows or in the notes of the financial statement with regard to the significant cash flows pertaining to PTF and PIF. So this is something that was at that point of time considered as a minimum disclosure. This if you, Brother Sanjeev and others who feel that PTF disclosure, PTF cash flows disclosures are important, do you believe that this B22 serves the purpose, or we still need a separate separate cash flow statement for PTF at least, even if not for PIF? So please, if you can put your comments in the Q&A box, that will be helpful. We have comments from Brother Ridwan Patel. The mention of CSM with outstanding claims seem to be a mix of IFRS 4 and 17. How should this be interpreted? Because under IFRS 17, there is no disclosure of outstanding claims. Brother Ridwan, thank you very much for an important comment. There are some of the alignments that are needed because this standard was developed before the other standard. So there were some of the alignments that were needed. For us, it will not be, the question will be, one part is clear, that the requirement of disclosures will be aligned with the requirements of the second standard, that is IFRS 17 equivalent standard. So the main accounting will be that of the TRM. Now, there will be one question as to whether the components of TRM need to be disclosed separately. So this is something from our perspective important, because we need to understand that outstanding claims, and now I would answer the comment from Brother Junaid Amanullah as well, which I said that I'll be answering that one separately. We try to align our standard maximum to IFRS, but there are some issues where there are some Sharia considerations. So for example, when IFRS 17 discounting effects are applied, we believe that according to Sharia, established receivable or established payable may not be discounted, which means that an outstanding claim, which is a established liability, shall not be discounted. So this is where a slight difference between AOFI standard and IFRS will still be there. So an outstanding claim where the claim is now established as of now and the liability is established as of now, that will not be discounted. So we will have to segregate it from the total liability, and the total liability will be discounted. Similarly, any established receivable will not be discounted, even if it is to be recovered over a period of time, because this is a Sharia consideration. Discounting a established liability or discounting a established receivable is equivalent to riba for the purpose of distribution of profits. So we actually, according to our framework and according to all our standards, we avoid anything like this. So even if we do the computation according to IFRS as close as possible, there will still be certain differences with regard to the established liabilities and established receivables. And for that purpose, outstanding claims which are established liability will still need to be disclosed separately and will be subject to not discounting, even if they are due in the long term. If they are due in the short term, like they are established and are to be paid in within 1, 2, 3 months, or immediately payable on demand or immediately, in those situations, the impact of the difference between our treatment and the IFRS treatment will not be significant, maybe immaterial at all. But still the disclosure part will be relevant. So that is the reason that some of these things might still need additional disclosures, and will still insist on some of the treatments which are as per our framework and our other standards and FAS 1, and not as per IFRS. But we believe that normally the effect, the financial effect will be immaterial, and the results produced by our standard will be very close to IFRS 17. There is a comment from Brother Omar Mahmood. For clarity, Takaful will companies applying AAOIFI standards and those applying IFRS 17 for conventional products and will have different liability calculation models. Brother Omar, I'm not very clear. Are you talking about Windows, or you are talking about Takaful companies applying AAOIFI standards and those applying IFRS 17 for the commercial product and will have different liability calculation models? Our calculation model is very similar to IFRS 17. Very similar. As I mentioned, there might be very minor one of a few differences. The Wakala is a difference. Instead of CSM, we have TRM, but that is more or less the same. In the cash flows, we consider most of the things except for surplus distribution. That is one effect that we need to still consider towards finalization about surplus distribution. So these are the things. But otherwise, our standard will produce more or less the same results, and more or less the same computation engines with some minor amendment will be used for the purpose of calculating the liability and results. I hope it is enough as your answer, but if it is not still clear or I was unable to understand your question, kindly let me know again. There is a comment by Brother Abdurrahman Abu Bakr. When you have contributions receivable, can you have Wakala receivable on the contributions? This depends, Brother Abdurrahman, this depends on the contract between the Takaful institution and the PTF. So if the contract says that this will be based on the total wakala, whether total contributions, whether received or not, then it will be done on a total basis, which means that even on the receivables you can receive it. The other approach, which we believe is the prudent approach, is that the Takaful company will take the Wakala contributions on a receipt basis. So when the contributions are received, they receive their part of it. So in that situation, they will still show a receivable of Wakala. Some companies have a policy of paying Wakala on a monthly or a quarterly basis, not on a daily basis or live basis. So in that situation, there can still be a wakala receivable appearing from the PTF till the end of the period. So there are different situations which are according to the contract and according to the working model, but it doesn't make a difference from accounting perspective, computation perspective, we believe. Brother Jafar Iqbal has a comment. How about including the right of use asset under assets as required under IFRS 16? Brother Jafar, this is our issue related to our FAS 32. And when we were doing the FAS 32, we had a conscious decision that right of use asset is not equivalent to property, plant, and equipment. And our Ijara transactions are different from the conventional transactions. In the conventional transactions, in a finance lease, substantially all risk and rewards are transferred. So they include it in the PPE, considering that it is equivalent to PPE. We believe that according to Sharia, the usufruct, that is the term, we use the term usufruct, the manfa. So we believe that right of use asset or usufruct is not equivalent to physical ownership of PPE. So we do not include it in PPE. So that is a conscious decision. Right now, I do not want to go in further detail for this one because this is a subject that is of FAS 32, not of this FAS that we are discussing right now. Brother Sanjeev again mentioned about this one, the separate PTF. I believe we are talking about the cash flows. So I think, thank you very much, Brother Sanjeev. We will take it to the working group, and I think my personal suggestion will be in line with your suggestion that for PTF the cash flow should be there. Brother Ridwan Patel, from Sharia perspective, we only discounting for accounting purposes, so I don't not fully understand this. If we discount, it would be riba irrespective. Brother Ridwan, it's a big debate that we have discussed earlier in multiple standards and the framework particularly. But let me be very clear on that. When we say that receivables are not discounted or payables are not discounted, this is a Sharia requirement. This is number one, according to Sharia, you cannot do it. So if you cannot do it, then the rate is zero. So there is no discounting anyway. So even from the technical standpoint, the only rate that you can apply to that is zero. And that's why it becomes zero. So you cannot do that. Now, so technically it cannot be discounted. Now, from the other point, if you apply a rate to that, and you discount it, what happens? What happens that if you discount it, then this discounting effect is taken either to the PTF or to the shareholder fund P&L, and which means that you are distributing that profit or loss either way to the shareholders or the participatory stakeholders or the participants, etc., which is not an income or expense according to Sharia, and which is equivalent to riba for that purpose. So again, we as AOIFI have a very considered view that any established receivable or payable cannot be discounted. And if it is discounted, it means that its counter effect is being distributed to the investment account holders or to participatory stakeholders or to shareholders or to participants of the PTF or the participants of PIF, etc. In a nutshell, it's not only, we say it's only an accounting matter how it becomes riba. Okay, you do this accounting, but you change this profit or loss which is coming from this discounting changes the amounts of profits and losses which are attributable to the participatory stakeholders, including shareholders and all others. So it means that the income that is being distributed to them includes the discounting effect either way, means as a gain or loss, which in our view, even if it is not a direct riba, it's equivalent and very similar to riba. And that's the reason that we are very clear, according to AOIFI standards, any of the AOIFI standards, a receivable or payable which is established debt or any other monetary item, directly monetary item, is not discounted or there is no appreciation of that. This is inconsistent with our framework, our FAS 1 and other standards. So we cannot change the policy only for Takaful here. There is a comment to send the training materials. Your name is not there. This is Dell Optiplex 3080. I think it's not a computer with artificial intelligence, so it's a brother or sister. So I request all of you who use the computer name or the mobile name or the or anonymous attendee, we just request that you can put your names or initials. That would be good. So anyway, these are not training materials. This is the text of the standard only. When we do the public hearings, we do not have any additional presentations. It is only the text of the standard which is shown in a presentation format. The text of the standard is available in PDF form at our website. Anybody who wants that, they can reach out our website, or just they can do a direct search on Google and they can find it and download it. Is there clear guidance on why a company should apply discounting and when they should not? The most important guidance that is available on that aspect is in our framework. In our framework, there is a complete chapter on the Sharia rules as to how they are converted into accounting rules. This is a very important read for any accountant who is interested in Islamic finance accounting. I suggest that you should read our framework. And particularly that is chapter 7 or something of the framework, which actually talks about different Sharia principles and rules as to how they are converted into accounting rules. For example, Sharia does not allow two contracts to be combined as one contract. Safaqatan fi safaqa is not allowed, for example. So our accounting rule that comes from that is that you cannot combine the effects of two transactions from accounting perspective, and rather you need to take them separately for accounting purpose as well. Similarly, this issue of established receivable and payable comes from there. So this is a suggested reading, our framework, and this is a suggested reading for that purpose. Okay, so let's quickly try to complete this one because we have to take a break as well. There is another comment, again, presentation slideshow. I just mentioned about that this is only the text of the standard and it is not available. The only thing that is available is our PDF, which is available on the website. Okay, there is another comment from brother Nizar Dawood. Upfront fakala fee received, how the accounting treatment recognized as income upon receipt? It's a very good question, brother Nizar, but I think this is not the right place. We have the answer to it in the second standard. Particularly the last chapter of the standard is about these specific treatments, about recognition of fakala fee and recognition of receivables and and the impairment of receivables and the transactions between the different funds like operator fund and PTF and PIF, etc. So those answers are provided there. I'll request you to wait till we reach that point. So with that, we have a statement of cash flows. Then we have a statement of financial position of the managed PTF. We have the minimum disclosure requirements here. That statement of shall include the PTF's assets, liabilities, and net assets. Sister Farida, please note it down. The comma before "and" is a consistent thing in this standard. We need to make it according to writing practices. Participants' assets shall not be set off against participants' liabilities, and participant liabilities shall not be set off against participant asset unless there is a specific requirement of a relevant FAS or requirement of Sharia principles and rules or a legally enforceable right to set off. So the assets and liabilities are to be shown separately. Significant items shall not be combined on the face of the statement. The amount of any allowance established to cover expected losses or impairment shall be disclosed. Its assets and liabilities shall be combined into groups for better understanding. Subtotals of assets, liabilities, and participant funds shall be disclosed. So these were the general rules. Then we have cash and bank balances, deposits with regulators, receivable from Takaful institution, contributions receivable from Takaful, distinguishing between claims and commissions, other accounts receivable, investment in real estate, investment in sukuk, investment in shares, income tax asset if applicable, distinguishing between current and deferred. Ideally speaking, let me clarify one point. Ideally speaking, PTF is based on tabarro, so based on the general concept of taxation of doctrine of mutuality. The doctrine of mutuality is a generally understood legal maxim for the taxation system, whereby anything which is for mutuality is exempt from income taxes. However, in some since the proper taxation regime is not available for Takaful, we have seen that Takaful institutions are being taxed in different parts of the world on a consolidated basis. If these are taxed on a consolidated basis, then the appropriate amount of taxation that pertains to the PTF or PIF shall be allocated to the PTF and PIF. This is something that is a weakness in the industry right now that needs to be resolved. Then on the liability side, due to the Takaful institution, Qardhas and payables, and along with the significant terms and conditions, including the expected periods of payment, due to financial statement, due to other counterparties, etc., liabilities for incurred claims, including the outstanding claims and the claims incurred but not reported, provisions for remaining coverage, including technical provisions, including deferred contributions. Some of these things will be aligned after the IFRS 17 effect, so some of these things might need to change. We have received comments on it already, and this is already on agenda to align both standards before we finally issue them. Incurred claims and remaining coverage related to the Takaful institution and other parties' share of outstanding claims. Takaful credit balance, including provisions, accrual, and other components thereof, and then provisions, accruals, and other liabilities. Sister Farida, the same typo error is here. A reconciliation of insurance contract balance and Takaful contract balance for both the issued and the held contract shall be provided in a suitable manner. Just let me clarify one thing. The IFRS 17 uses the term insurance contract, but we, after long discussions, decided that we will be using the term Takaful arrangement, not Takaful contract, because it's not a single commutative exchange contract, and rather it's an arrangement of multiple contracts or based on tabarru. So we are using the term Takaful arrangement. So these are the things that need to be aligned between the two standards, because these things were decided in the second standard. So the first standard's terminology will be updated according to, and some of the disclosure requirements will be updated according to the way second standard is finalized. Then net assets of PTF shall be presented on the face of the statement, duly disclosing the fund balances, accumulated deficit, or any other undistributed surplus or any reserves. Then a statement of financial activities of managed PTF includes gross contribution, wakala fee, Takaful share, changes or movement in deferred contribution, earned contribution. As I mentioned, some of these things will be updated according to the IFRS 17 requirements and the second phase requirements. So these are going to be updated. So these are the statement of financial activities showing the overall movement. I'm not going to item by item. If we have any comments, I'll be more than willing to take the comments, but we cannot go for each and every item separately. Then we have a statement of financial activities of managed PTF. The statement shall also disclose movement in accumulated surplus or deficit. That is an important part as well. If there are reserves like profit equalization reserve and the investment risk reserve, PR and IRR, those should be disclosed properly as well. Their movement, etc., should be disclosed. Then we have if there are any non-compliant reinsurance arrangements or anything, non-compliant income, etc., those are also to be disclosed. Next, we have a statement of managed PIF. The statement of managed PIF shall segregate managed assets by source from the managed investment account and investment units and managed investment portfolios, etc. In addition, the statement shall segregate investment portfolios by type. So it can be a columnar statement. We are not defining a single form, but it has to identify the things. Now, it starts with the opening balances of the managed assets. And then even if there are unit-linked funds, then the number of units also are required to be disclosed. Then the purchases and additional investments and purchases and withdrawals and the investment profits paid as Mudarif fee or Mudarif share or wakala fee, etc. And any direct expenses or overheads that are charged. So these are the requirements, and it ends with the closing balance. So this is the movement statement. So by putting a movement statement, we we ensured that we don't put two different statements, because if it was not a movement statement, then it would have been a separate balance sheet and P&L. Now we put it as a movement statement in a single format. This is in line with the treatment that we did for the managed assets in the banking industry. So FAS 1 also requires for the off-balance sheet managed assets to be disclosed in a single movement statement. This is actually just to make sure that the number of primary statements is reduced, and considering the nature, the maximum information can be provided within one statement. We believe that. But again, if the participants believe that additional statements are needed for PIF as well, please let us know. So with that, we have these general disclosure requirements. One important thing that I mentioned earlier as well, in rare cases, the managed PIF is based on unrestricted mudarba, including the right of and a practice of commingling PIF with the institution's own fund. The rebuttable presumption is that such funds are under control of the Takaful institution and hence shall be presented on balance sheet as quasi-equity rather than being presented as off-balance sheet managed fund. So if the situation is like this, then in that situation, it will go to the institution balance sheet, and it will not be shown in the separate statement like this. Rather, it will be taken to the institution balance sheet. This is a very rare circumstances. We don't believe it will happen quite a lot. We haven't seen any example of that, but only because of our fundamental conceptual framework requirements, we felt that if it happens like this, then it has to be disclosed like this. So then we have basis of conclusion. I'm not going to basis of conclusion for this one. And we just, it is 11:34, so we have reached the time for a break. We have a comment from Brother Jamshid Rusulov. Is there any permitted fixed rate to calculate Murabha contract profit margins? The answer is this is a contractual thing. We don't have a fixed rate. This is a contractual thing. So whatever is a contractual according to Sharia principles and rules, then it will be according to that. Can PIF disclosure be addressed in the notes instead of primary statement, Brother Sanjeev? The answer is that it's a single statement, and if you want to completely eliminate the single statement and put in only notes, then it is not allowed by the standard. But if you want to make a very simple primary statement and put everything else in notes, that is allowed. The standard says that you can put all the necessary disclosures in the notes, and you can keep a very simple PIF statement like opening balance, additional investment, withdrawals, closing profit loss, distributed profit loss. Distributed will be even added to the value, so it will not be shown. Profit and loss, profit or loss attributed to the mudarib or working partner, profit attributed to them. So these are the things actually that will be appearing, but a primary statement is necessary, brother. Brother Ahmed Raza has a comment. Where is the disclosure requirement regarding the Takaful model to be mentioned? The models being Mudarba or Wakala or something else. So where is the particular detail mentioned? Our standard is very clear. The disclosure requirement about the Takaful model is in the accounting policies, etc. There is a requirement to disclose that. Additionally, the standard, as if you were there in the beginning, I mentioned that there is a presumption. And actually, after the contents, there is a box in all of our standards that clarifies one thing, that these standards are to be read with the relevant Sharia standards. So I mentioned in the beginning, if you were there, you might have noted that I mentioned that we might need to clarify that part in scope in this standard in particular as well. So, but the Mudarba model or the cooperative insurance model or the new coming Tasir model, these are not acceptable according to AAOIFI Sharia standards. So again, I'm not saying those are haram. If anybody want to follow those scholars who allow those models, it's up to them. But the consensus-based models of AAOIFI Sharia standard does not include Mudarba model or cooperative model or Tasir model. These are based on Wakala model. Only Wakala Waqf model fulfills all the requirements of Wakala model. and hence we consider that equally acceptable. Okay, I got your name, but to be honest, on a lighter note, it should have been mentioned with Miss or Mr. because from the name only I cannot define that. So anyway, thank you for mentioning your name, and you are most welcome. With that, we take a break. We take a break of. It was supposed to be a break of 30 minutes, but maybe we can take a break of roughly 25-27 minutes till 12:05 Bahrain time. And at 12:05 Bahrain time, we join again. We will quickly take any remaining comments on this standard, and then we will start discussion on the second standard. So with that, we take a break of nearly half an hour, and we'll join back again at 12:05 Bahrain time, inshallah. So see you in roughly 25-30 minutes. Assalamu alaikum wa rahmatullahi wa barakatuh. Auzu billahi minash shaitanir rajim. Bismillahir rahmanir rahim. Let's start again. We took a break for actually for prayers, etc., but also for tea, etc. If anybody you need to pick something up, and now we are starting again. And I can see 2-3 comments. Sheikh Bilal, Jazakumullah khairan. You are welcome, sir. Brother Ismail Mujahid, Walaikum Assalam Rahmatullahi wa Barakatuh. Yes, we are just starting, sir. So it was a break for prayers, etc. We are just starting. Mufti Aziz Rahman Sahab, Assalamu alaikum. Thank you very much for joining us, sir. We are always learning from you. Thanks for your comment. The second part of the public hearing we are starting right now, in which we will be discussing the second standard, and that is the standard on recognition and measurement. That is the equivalent of IFRS 17. I think on the chat window, I received a comment with regard to my email contact. Let me answer that. My email is available to everybody. oansari@aofi.com. I'm just writing that my email on contact detail as well, and accounting@aofi.com is the one that on which you can send all your comments on this standard or any other accounting standard. I think there were some comments by Brother Kashif, and he said that I cannot join, I cannot make comments on the QA because I'm panelist. So I think Brother Kashif, would you like to, are you there? Would you like to mention your comments by switching on your microphone? Brother Kashif Siddiqui, I think you had put some comments.
Yeah, yeah, I put some comment that whenever we are reporting this financial statements, the effective date should be applicable on the annual financial reporting, not in between.
Yes. So it will be the effective date. Whenever we put an effective date, the effective date is for the periods beginning on or after this date. Let me check the way it is written here right now. Let me just quickly check it, because
it should be annual financial statement.
You don't want it to be on the periodic?
Because IFRS 17 also allowed the same way.
Okay. It's a good point, Brother Kashif. So you are saying that IFRS 17 has allowed a sort of relaxation that for the first 3 quarters, you are not required to follow this?
Yes.
Okay. It's a good point. Brother Harun, Sister Farida.
Yes, Brother.
Can you please take a note of this very important point that according to Brother Kashif, the IFRS 17 is allowing this to become on first annual financial statement, which means the 3 quarters are not required because there are so many complications. So they are not requiring it to be applied on the 3 quarters. So this is a very important point. If IFRS has provided this flexibility, then we should also provide this flexibility in our standard. Thank you very much, brother. Although again, I wanted to see in the QA tab, but on the chat tab, there is another comment. The actuaries already discount the liabilities, mathematical reserves for family Takaful life business under the current reporting framework. That is correct, and that is something that we don't want. We believe that it is not correct as per AOFI. So, Brother Zohaib Khan, kindly make a note of this one, that this is a difference between AOFI and IFRS. And we need to take into consideration because it becomes a Sharia non-compliance issue. But to be honest, if most of these are established liabilities or receivable as of day one, so the period is already 0. So at times there is no discounting at all. But yes, if there is for example, if there is an established liability which becomes payable for future periods, for example, if it's the children education plan where the person died and you have to make payments for next 5 years equivalent to X amount of currency units. So there can be an argument about that, whether it's established liability or not. There is one view that it's not established liability, because even if the student himself doesn't study, or he is kicked out of the university, or if he or she is God forbid he or she dies, so there is an argument that this is still subject to certain additional conditions, like actually being educated, actually being in a university or a school, and actually being living to that period. So there is an argument that it's not established liability. The other argument is that yes, no, it's established liability, because other conditions are very minimal then. So in that situation, it can be a long-term thing which is subject to discounting under the conventional practices and should not be discounted according to Sharia practices. But other than that, most other liabilities are due now. Any established liability is due today. So when it is due today, normally you also do not discount it. Even the actuaries under the conventional framework don't discount it, because the period is zero. So if the period is zero, so I think in that situation it applies. So it's a just general comment about this point. So I think my mistake that I have, the comment that I have provided is to one person only. So let me write it down again. I have to give it to everyone. I was writing the email address, so I had to write it for everyone. Okay. With that, I can see another comment from Brother Sanjeev. That it would be more beneficial if AAOIFI can update and reissue the presentation and disclosure exposure draft after aligning the same with recognition and measurement exposure draft. Brother Sanjeev, to be honest, it's a good point. I don't have a disagreement. The only thing is that can we go through the whole process again, because the effective date issue is there. But yes, we will take your point to the board, that after, because there will be some minor changes and some, again, we don't believe there will be major changes, but on the presentation and disclosure, there will be alignment part. So we will ask the board and we'll take it to the board. Our target is to issue it by end of the year. So if the board wants to issue another exposure draft for maybe with a very short, period of time, like 15 days hearing time, so I'm okay. But we want to finalize because we will be taking it to the board in September, inshallah. The board meeting is planned in September. Arabic public hearing will be in the beginning of next month, inshallah. So after that, we'll compile everything and we'll take to working group. Maybe in the meanwhile, Sister Farida and Brother Harun, please make a note of it, Brother Majd. Please make a note of it that if we need to issue another exposure draft, then we need to hold the working groups immediately, and maybe the Arabic public hearing comments may be taken at the next stage as well, if we want to do it 2 times. So my suggestion is that if we can discuss it with the working group chairman and the board chairman, and we can send an email to the board that if they want to have another issue, another round of exposure draft, in that situation, we might need to hurry up on finalization of this standard, and then issuing another exposure draft and giving at least 2 weeks time for another sort of round of comments. Maybe not a public hearing, but at least a round of comments. So this is something, I think it's a very good suggestion by Brother Sanjeev, but I cannot decide on behalf of the working group or the board. Only thing is that we can take to them. And but still the target of finalizing the standard within this year is still there. So even if we want to do this additional round of exposure draft, we need to do it very quickly. So
Brother Omar, the upcoming Arabic public hearing is planned to take place on the 10th of August, roughly, inshallah.
Yeah. So can we hold the working group immediately after that? So that we can try to finalize it early. But the point is that because I think the 2 or 3 of the working group meeting might be needed even, because there are a lot of comments.
We are having it, yes, tentatively it is on the 17th, so it's about a week after the Arabic one, the first one.
Okay, let's in between, I think we just need to check with the accounting board chairman, deputy chairman, and the working group chairman what do they think about having another exposure draft, because the policy of AOIFI is clear. If there are major changes in the standard, we issue another exposure draft. But if there are not major changes, then we normally put, we just put like basis of conclusion with regard to significant suggestions, but and public comments, but we do not put it again. So I'm just afraid that going through the whole round would take too much time, and the only issue is that we need to identify whether the changes that are being made are significant or less significant. One thing we are clear that the standard number 1 will be aligned with the requirements of standard number 2 and IFRS 17. That's we are clear. But thank you again, Brother Sanjeev, for your comment, and we take it seriously, and we'll take it to the board and working group, and then we'll see how it moves on. Is the sound having a problem? Somebody has commented that the sound is having a problem.
No, it's okay.
brother. It's okay.
Can anybody from outside confirm in the chat window, anybody who is having the voice issue, because one of the participants has mentioned about the voice issue. So maybe the voice issue is for everybody or only for 1 or 2 people. If it is for 1 or 2 people, they should log out and log in again. Normally the issue is resolved this way. But if it is about this at our end, then we need to sort it out at our end. So please let me know. Okay, so general comment is that the voice is clear. So I think that we can move ahead, and our brothers and sisters who may have a voice problem, they need to log out and log in again. Thank you. Let me now take you through the next standard. So this standard is about accounting for Takaful recognition and measurement. Okay, so this is, as I mentioned earlier, it's our IFRS 17 equivalent. A lot of things we have discussed, particularly on the conceptual part, so I will not repeat them. With regard to the introduction part, just one thing to mention that it will replace our FAS 13 disclosure of basis of determining and allocating surplus, FAS 15 provisions and reserves, and FAS 19 contributions. So these 3 standards are related to the accounting and recognition and measurement part. So these 3 will be superseded by this standard, which is aligned to a significant extent with IFRS 17. I think, to be honest, putting a long list of significant changes is very difficult because so many things have changed. But the most important things is that this one is aligned with the conceptual framework. This is aligned with IFRS 17. Alignment of treatments, etc., has been performed with earlier issued FAS. This one, the principal accounting treatments of Takaful are aligned with generally accepted accounting principle, that is IFRS 17. New accounting treatments have been introduced in respect of matters which were not addressed by the superseded standards, particularly with regard to provision, etc. Accounting treatments related to are mapped with Sharia principles and rules for Takaful, particularly rights and obligations, etc. New definitions have been brought in. Accounting treatments have been introduced for ancillary transactions like wakala, impairment of wakala, pardasan, impairment Parthasan and impairment of Parthasan, and receivables and payables related to wakala and other fee, the seed money, and so many issues which are specific to Takaful industry, which are not addressed by IFRS 17 because those are not relevant to IFRS 17 and conventional insurance. So those issues have been included here. Objective of the standard is to set out the principle for recognition and measurement of Takaful arrangements. As I mentioned earlier, we are using the term arrangement. Arrangement means it's not a single contract, rather it's a combination of contracts and arrangements with regard to which may include the tabarruk contracts, two different tabarruk contracts, which include the contracts and arrangements between for wakala and others between the different reporting entities within the Takaful institution, etc. So we have used the term Takaful arrangements, and ancillary transactions are also covered, as I mentioned about it. The scope of the standard shall be applicable to Takaful institutions and they managed for PTF and managed PIF in respect of Takaful arrangements, including re-Takaful arrangements issued, re-Takaful arrangements held, investment contracts with or without discretionary features that are issued along with and being part of the Takaful arrangements, ancillary transactions related to Takaful operations. Takaful institution shall not apply this standard to guarantee contracts unless the issuer has specified them to be in the nature of Takaful arrangement, and the Takaful arrangements which are where the Takaful institution is the participant or the policy holder unless those arrangements are re-Takaful in nature. On the definition side, contribution is the gross amount that a participant undertakes to pay in respect of a Takaful arrangement issued by a PTF. Entitlement period is the period during which the PTF provides entitlements for benefits to the participant. This period includes the entitlements for benefits that relate to all contributions and investment components where applicable within the boundary of the Takaful arrangement. Fair value of future cash flows in the specific context of this standard of an asset or provision not being an established debt. Now, this is a very clear exclusion. We have discussed this issue already, so I'm not going to repeat on that. But this is excluded. Is the estimated value equivalent to the fair value of an otherwise permissible exchange of an asset or liability having similar cash flows with a knowledgeable billing party or on an arm's length basis? Explanation. For avoidance of doubt, it is clarified that the estimate of such value may take into account the consideration applied in similar transactions, including discounting of cash flows, to arrive at the fair value acceptable to such counterparty. So we are not saying discounting, we are saying estimating fair value of cash flow. Now, estimating fair value of cash flow may take into consideration the discounting effect, but we are not directly discounting the cash flows. We are estimating the fair values of these cash flows, and then we are amortizing the fair value and the cash value differences. Financial risk in the specific context of this standard is the risk affecting the fair values of future cash flows arising through a possible future change in one or more of a specific benchmark rate, investment for investments asset price, commodity price, currency exchange rate, index of prices or rates, credit rating or credit index or other variable, provided that any non-financial variable among such factors is not specific to a party to the Takaful arrangement. Liability for incurred claim is the obligation to investigate and pay valid claims for benefits against events that have already occurred and other incurred Takaful costs. Onerous arrangement is a Takaful arrangement where the unavoidable cost of meeting the obligation under the Takaful arrangement exceeds the economic benefits expected to be received under the Takaful arrangement. Participants investment fund and participant Takaful fund, we have gone through the definition. It's more or less the same. Provision for remaining entitlement period, a very important term, is the obligation to investigate and pay valid claims for the benefits under existing Takaful arrangements for events that have not yet occurred. That is the obligation that relates to the unexpired period of the entitlement, portion of the entitlement period. Qard, we have gone through the definition. Reinsurance, we have gone through the definition. Re-Takaful, we refer to this definition. Actually, we came to this definition earlier while we were discussing the other standard. Risk adjustment for non-financial risk is the sustainability margin the PTF needs to maintain for bearing the uncertainty about the amount and timing of the cash flows that arises from non-financial risk as the PTF fulfills Takaful arrangements. I think there are 2-3 comments on the QA tab. Anonymous attendee, if we look at the liabilities disclosure in the PTF that reflects the remaining coverage provision, I am unclear how this flows through the PTF income statement. Now, there was another comment by somebody in the chat box, actually, now I recall that, about the illustrative financial statements. Actually, some of the things are more about presentation requirements. So when we develop the standard, we put the presentation requirements, but how those presentation requirements are actually reflected in the financial statement depends on the sequence of transaction recording and reporting. So as of now, I would just say that I do not have an exact answer to your question right now. But number one, we will take it into consideration, and we'll see and make sure that we don't make a mistake. If you feel that we are making a mistake, I would request you to kindly clarify your comment more. So if you feel that the way you are trying to put in numbers, it doesn't match, or there is an error in the requirement, the way we have presented in the standard, we request you to kindly check it and let us know. I would request particularly Brother Sanjeev and others also who belong to the finance departments of these Takaful entities, if they can let us understand if there is something actually wrong in the way we have done it. However, how it actually flows, as I mentioned, we will be trying to do it in the illustrative financial statements. Immediately with this step of public hearings, we will start working on the illustrative financial statements as well. Actually, I think we started some time back as well. So we'll be pushing it fast to try to come up with illustrative financial statements. At times, illustrative financial statements actually help us understand better how the transactions and numbers flow. So for that, number one, we'll try to do our part with the illustratives. Number two, we'll try to have a quick look at if we are doing a mistake, if it is not making sense the way it is presented. And as I discussed already, that we are going to align the two standards as well. So we are going to make sure that this doesn't happen. I would request Sister Farida and Brother Harun particularly to make comment of this point, that remaining covering provision, how we are going to show that, how it is going to flow, either we are going to show the movement of the closing balance and how the numbers tie up. So this is very important comment. Thank you very much. We will be highly obliged if you can provide additional comment to that. You or any other colleague here can provide us additional guidance. That is the whole purpose of having this public hearing. So while I don't have a quick answer to your question, I assure you that we'll try to make sure that it works out properly, inshallah. We have Brother Hikmatullah Sahib. I found the usage of Islamic insurance instead of Takaful unnecessary. We are not going to use the term Islamic insurance. We are going to use the term Takaful. Only at one place we mentioned that in some jurisdictions it's referred to as Islamic insurance. This is because in some jurisdictions the Takaful term is not acceptable. Other than that, we are perfectly okay. And again, one more thing, that if you call anything, they say that a rose will be a rose by whatever name called. So that applies to all our transactions and standards, that if it is Takaful in principle, even if it is not by the name of Takaful, then still it will apply on that business. I personally remember several years back when I was not at AAOIFI, I was in Islamic Finance Consulting with EY. I developed a whole Takaful model for a US, it was never launched, but I developed that model that was based on reciprocal insurance. And I can assure you that was a fully Sharia compliant model and fulfilling all the requirements of Takaful. But the name was not Takaful because the legal provisions were not there, and the name was reciprocal insurance. So in my humble view, we are using the term Takaful, but only at one place in the definition we mentioned that this is also referred to as Islamic insurance. If it fulfills all the characteristics of Takaful according to our Sharia standard, then it is acceptable. But overall, we use only the term Takaful. Brother Jafar Iqbal, as I understand, paragraph B137 of IFRS 17 mentions about interim financial statements applying IAS 34 financial reporting and not just annual financial statement. Brother Muhammad Jafar Iqbal, thank you very much for your kind comment. I believe it has to apply on interims. The only thing is that for the first year, what I understand, the comment of Brother Kashif is that IFRS 17 has applied only for the first year that it applies on the annual, only for the first year. So it does not mean that it will not be applicable on interim. The point is, as I understand from Brother Kashif, which we will check with IFRS and will make sure that we keep it consistent with IFRS, is that according to Brother Kashif, only for the first year, because all the numbers and everything is not available. So only for the first year, the requirement is coming for the annual, not for the interim. But this is only for the first year. It's not about that it is exempt from interim on an ongoing basis. No, it's about only the first year. maybe we can put something on the transitional provision rather than putting in the effective date. So this is something that we can give it as an option or something. But if I understand Brother Kashif Siddiqui correctly, he is not saying that interim are not required. He's just saying that only for the first year, IFRS has allowed that interim are not subject to this, and rather only the annual are subject to this. I hope there is no difference of opinion, but Brother Jafar, I would, and Sister Farida and Brother Harun, I would request if you can just take a note of the reference by Brother Jafar and check and map it with the comment of Brother Kashif Siddiqui, and make sure that we do what is actually required by IFRS, because there is, we have a simple rule. If there is nothing against Sharia, we keep our standards aligned with the IFRS. That's the approach. So inshallah, we'll try to keep it aligned, because I don't feel any Sharia issue in this matter. Now, moving ahead, there is one more comment again. Okay, it's thank you. You are welcome, sir. Okay. Now, coming to risk adjustment for non-financial risk is the sustainability margin the PTF needs to maintain for bearing the uncertainty about the amount and timing of the cash flows that arise from non-financial risk as the PTF fulfills the Takaful arrangement. So on a general comment, I would say that PTF should have a zero. This is an ideal, in an ideal situation, PTF should have a zero Takaful residual margin. But still, for the purpose of managing risk for the remaining transactions, the risk adjustment part has to be there. So after putting the risk adjustment part, the TRN should ideally be zero. But again, we don't live in ideal conditions, so there will be TRN, because wakala fee might not always be equivalent to that part. So obviously, at times there will be positive, there will be negative. Takaful definition we have gone through. Takaful acquisition cash flows arise from the cost. Okay, one thing. On the acquisition cash flow part, we have differentiated between two things: acquisition cash flows and acquisition service cost. Now, what is acquisition cash flow and what is acquisition service cost? So first we need to understand that Takaful acquisition cash flow is something that is in PTF, and Takaful acquisition service cost is something which is in the company accounts, not in the PTF accounts. So Takaful acquisition cash flow arise from the cost borne by PTF directly attributable to the first time acquisition of a Takaful arrangement. Explanation: these may include costs initially borne by the PTF, for example, surveyor costs, initial medical costs, documentation, legal charges, tracker or other security devices costs, etc., but does not include one wakala fee or two commission, because it's generally borne by the Takaful institution against wakala fee. This is something which needs some amendment, because according to Sharia standard, commission may also be charged. According to the regulatory standards, we believe that regulators and even AAOIFI accounting board as a best practice prefers that commission should not be charged. So I think we will be amending this part slightly to allow both options. But our preference is that wakala fee should include commission, and commission should not be charged here. So, but we already mentioned in line with Sharia principles and rules as well as regulatory requirements. So it is already mentioned. Or that three directly related taxes, that these do not constitute part of the contributions and are required to be recorded directly. For example, if there is a value-added tax or a duty or any form of other taxes, so those are to be recorded separately. So they are not part of acquisition cash flows. Now, Takaful acquisition service costs are the cost borne by the Takaful institution. This is the part of the institution, the operator, attributable to first-time acquisition of a Takaful arrangement, which are not part of Takaful acquisition cash flows. For explanation, these may include costs such as commission, documentation charges, which are not recovered from the participant, etc. Takaful arrangement is a combination of non-commutative. Now, this is a very important definition which we need to understand, because it's a replacement of insurance contract definition from IFRS. Takaful arrangement is a combination of non-commutative, non-exchange investments or service contract entered into mutually by the participants of a PTF of a Takaful institution in order to provide mutual Takaful entitlement for benefits and ancillary services, some of which may be with the Takaful institution as a service provider. Takaful fulfillment cash flows is an explicit, unbiased, and probably weighted estimate, that is the expected value of the fair value of the future cash flows minus the fair value of the future cash inflows, that will arise as the PTF fulfills Takaful arrangement, including a risk adjustment for non-financial risk. Explanation: Wakala fee to be paid by the PTF to the Takaful institution is part of the future cash outflows for such purpose, and hence it is included in the Takaful fulfillment cash flows. Since we put Takaful Wakala fee here, so generally, as I mentioned earlier, generally the TRM should become 0. Takaful institution is an entity possessing the license of practicing Takaful, at times referred to as Islamic insurance business, in line with the requirements of Sharia principles and rules. The institution undertakes its operation based on a remunerated Wakala agency contract. In addition to managing the Takaful operation, the institution also assumes the responsibility of investing the assets of the fund through Mudarba or investment agency. Explanation: for the purpose of this standard, a Takaful institution includes a Takaful window operation. The notion Takaful institution, unless the context suggests otherwise, includes the Takaful operator and participants fund. However, we today received a comment that Takaful institution and Takaful operator we should use separately. So for shareholder fund related everything, we should be using the term Takaful operator, and Takaful institution we should use only where we are talking about all the institution combined, including all these funds. So this is one very important comment that we have taken note of today. Takaful residual margin. Now, this is a replacement of contractual service margin. Takaful residual margin. Now, why we use the term residual margin, Takaful residual margin, rather contractual service margin? First thing, conceptually, insurance is a risk, sale and transfer business. So this is a service, but Takaful is not a service. Takaful is a mutual sharing of risk, which means that there has to be a residual margin, but it's not a service provider and it's not a residual, there can be no residual service margin, because it eventually there has to be a surplus distribution as well. So we decided that the Takaful residual margin is a much better term. We discussed multiple terms for that purpose, and if the participants are willing to provide us with some more suitable terms, please feel free for that. We will be considering that before we finalize the standard, but we have gone through long discussion on this part, and this was considered to be the best possible term. So from that perspective, Takaful residual margin is the component of the carrying amount of the asset or liability for Takaful arrangement or a group of Takaful arrangements representing the unearned surplus or at times unrecognized net cost, applicable in case of these Takaful contracts held only. The PTF will recognize it as provides benefits under the Takaful arrangement. Explanation: the TRM is a risk share in a risk sharing model business. Risk sharing Takaful business is, from accounting perspective, quite similar to contractual service margin under the conventional risk transfer based insurance business. Then we have definition for wakala fee, etc. Structure for Takaful, we have already gone through it word by word actually. So I'll skip that and we'll take the comments later as well if there are any comments. Now coming to accounting for Takaful arrangements. Now this part under general approach is more or less similar to what is in IFRS 17. But the main difference is that this applies only on the PTF, not on the company as a whole. This is very important point, that because some of the experts even on the conventional insurance side, we have seen some presentation at ISB level and others which actually identify that even a Takaful, who is the insurer within a Takaful business, even if we apply IFRS 17, who is the insurer? Is it the company or the fund? So the definition of insurance contract under IFRS and definition of insurance under IFRS apply to PTF actually. So from that perspective, we believe that even in those countries where AOIFI standards are not applicable and IFRS 17 application becomes mandatory, even we have a considered view for those countries that it should not apply on the whole of the entity, rather it should apply on the PTF only. And this is a very important comment, and we believe that if this is not complied with, this requirement is not complied with, we believe there are significant Sharia issues in that. Okay, so then we have the requirements related to unbundling of non-Takaful components which need to be segregated. This requirement is more or less similar to IFRS. Since we are having a bit less time, I'll be conceptual parts mostly we have discussed. The requirements here are more or less similar to IFRS. If I find any significant difference, I'll identify it to you. But because of limitation of time, again, we had a long, good discussion earlier. but now we have to rush through. So I'm going to skip a few points. Not going to detail of those points, and but you are welcome to provide comments now or later in writing for any of the areas which I do not discuss in detail. So then unbundling part is there. Then we are talking about group of Takaful arrangements. So again, like IFRS, we are allowing that you can do accounting for a single arrangement or on a group basis. We believe that normally it will be done on a group basis. The requirements for the group level of aggregation, those that we have put in are quite similar to IFRS. I think maybe the writing style of both standards is a bit different. So we have written it in the context of an individual arrangement, but groups are allowed, and IFRS more talks about group. But here, some of the places that in our standard also the group is more relevant, so we talk more about the group. But generally speaking, the requirements related to aggregation and unbundling, etc., are more or less similar as IFRS. Then we have the requirements these are more or less the similar requirements. I'm not going to repeat them, but the more important thing is that actually the onerous part, those arrangements that are expected to be converting into a loss situation are important. One very important consideration is there, which we have discussed at the appropriate place, but let me discuss it here, is that from the Takaful perspective, we are afraid that Takaful arrangements being onerous in nature, risk is much more as compared to insurance. Why? Because we have seen a very common practice, which I would say a bad practice in the industry, that the wakala fee is normally kept on a higher side. There are two reasons to that. Number one, some of the Takaful companies are newer, so they need higher Takaful wakala fees to manage their expenses. But there is another approach on a conscious basis that, okay, they want to keep the fund in a loss situation, because whenever the fund is in a loss, you can give Pardasan and you can take it back. But if the fund is in profit, then there is surplus that needs to be distributed. So at times, and earlier it was even possible that the fund is going into losses and you are actually keeping profits in the fund in the shareholder fund by showing better performance. Again, I'm not here to challenge all the subjective practices. What I'm saying that because in Takaful wakala fee is taken out, there is more probability of having onerous arrangements as compared to the conventional insurance, because conventional insurance take it on the overall entity basis. Here we are talking about taking it on the PTF basis. So there is a risk that lots and lots of arrangements and groups of arrangements might be in a loss situation. So this is something that you can find as a practical problem going forward. One of the issues that we have discussed upon is that if on a continuous basis the PTF is on a loss on a continuous basis, then there is a risk that the agent is actually negligent by putting by taking extra wakala fee more than the justified wakala fee, because every new incoming Takaful arrangement is getting into a loss. So this is one of the important issues. We have discussed it in the standard, and we talked about the issue of the negligent agent as well. Timing of initial recognition is when the participant becomes member, and the date when the Takaful arrangement being part of group or unavoidable commitment of the Takaful arrangement becomes onerous. So either it becomes onerous, or if the participant become a member, in both situations you take the starting point. Obviously, because of Sharia, the starting point as we have is slightly different from IFRS, but in most situations it will not be different. Then we are talking about Takaful fulfillment cash flows. It includes the estimate of future cash flows related to wakala fee and estimate of other future cash flows at fair value. Deferred cost being the difference between the total future cash flows, including wakala fee. So now the difference is that in IFRS, you directly take the discounted figure. Here we are not taking the discounted figure. We are taking the total value, and the fair value effect is identified separately. The fair value effect is the discounting effect. This discounting effect is to be amortized separately, so we are asking for its disclosure separately. Then there is risk adjustment for non-financial risk, and then the Takaful residual margin is the profit part or the loss part, as the case may be. So other than this this element of segregating the fair value versus the total cost element, which is a requirement of Sharia, as we believe, is other than that, the treatment, and we believe that the net result is generally going to be the same. Then what are to be included and for the provision for that purpose and what not. These are more or less aligned with the IFRS requirements. Where what are the considerations for the purpose of initial provision. Then I would go to the next point, the measurement of provision at initial recognition. A liability or asset shall not be recognized related to an expected provision or expected claim for benefit that is outside the boundary of the Takaful arrangement. This is again aligned with the IFRS, but this is about the future Takaful arrangement, so that is not included in the calculation part. Estimate of the future cash flows is to be adjusted to reflect the sustainability margin of PTF, bearing in the uncertainty about the amount and timing of cash flows also is to be considered. We believe that while wording and some disclosures at this stage are slightly different, but still more or less the treatments are the same. However, we have talked about one very important thing, that surplus distribution, if any, and waiver of Qardasan, if any, shall not be part of the fulfillment cash flows. They become part of, they are accounted for. So if they are not part of fulfillment cash flows, then technically they are kept in the Takaful residual margin for the time being, till the time they actually occur, till the time it actually happens that surplus is distributed or Qardasan is distributed. So same applies to on the other hand, the Mudarif share. So on the investments, if 20% of the investment income is the Mudarif share, then that has to be taken as a net into consideration while determining the fulfillment cash flow. So because it is a contractual expense, so it has to be taken into the fulfillment cash flows. But surplus distribution and Qardasan are not guaranteed, so they are not to be taken. So this is some very important clarification. Other than that, more or less the same as per IFRS treatment you apply here. Then on the initial recognition of TRM, the TRM is a component of the provision or net cost in case of certain Takaful arrangement held for a Takaful arrangement that represents the unearned surplus or deficit that will be recognized over the period of and where appropriate according to the pattern of the participants' entitlement for benefits under the Takaful arrangement. The TRM shall be measured at the difference of the fulfillment cash flows and any cash flows arising from Takaful arrangement at that date. So that is the net difference between the two. Initial recognition of onerous arrangements, any onerous arrangement, this is in line with our framework and this is in line with IFRS, that any arrangement that is onerous needs to be accounted for immediately. Any loss in the statement of financial activities of the managed PTF for the net outflow for onerous arrangement shall be recognized, resulting in the carrying amount of the provision being equal to Takaful fulfillment cash flows and Takaful residual margin becoming zero. So this is a clarification on the accounting part. Initial recognition of a significant number of onerous amendment. Now this is the issue that I discussed, that Wakala fee is excessive. So excessive Wakala fee issue needs to be addressed, and again, this is more of a governance and regulatory and Sharia issue, we believe, but it has its accounting impacts. So we have said that if it is established that it was excessive, and if it is established according to Sharia principles and rules or the regulatory requirements, then such receivable shall be part of the fulfillment cash flows. Yeah, I think we have one or two comments only. Let me take those comments. With reference to the release through the income statement of the provision of remaining coverage, my understanding is that this is how the profit will be recognized over the period. Is there a risk that if we show contributions, claims, and commission in the income statement of the PDF, that the provision is not released correctly and possibly double accounting? How do we reconcile the fulfillment cash flows? Now I understand your question very well. And I think before we finalize and issue the standard, we'll try to make a illustrative of this part only. If it works out properly and we can do it, we'll try to consider it, putting it as a part of the next year, or at least we'll keep it ready for providing guidance to the institutions. Thank you very much for very important comment. Inshallah, we'll take care of it. Brother Nizar Daud, TRM is equal to surplus from accounting perspective of Takaful. Yes, TRM is technically the surplus, but TRM can be negative, or TRM can become zero also in case of deficit. But yes, TRM is generally equivalent to the surplus, but it's not necessary that all of TRM is distributable. Brother Sanjeev has a good point. Is it possible to share the major difference between IFRS 17 and AAOIFI Takaful exposure draft? Actually, we are working right now for developing a complete list of differences between AAOIFI and IFRS, which will include Takaful for sure. But for the time being, if we can do it quickly, Sister Farida and Brother Harun,
Yes,
it comes to you. I think it will be helpful if we can at least keep it quickly ready and share with selected participants who are in need of it, as well as we can take it to the working group and the board as well to identify all the differences, major differences between IFRS 17 and our exposure draft. So I think we
for
need
terminology,
to do this.
yeah, Brother Umar, for terminology differences, it's already in the BOC, a few terminology differences,
Okay.
BC10.
No, we are
But
talking
accounting,
about all treatment differences.
Treatment
They
differences,
should be in
we'll
basis
try
of
to.
conclusion. To be honest, they should be based in basis of conclusion.
Yeah, we'll try to maybe edit in there.
Thank you. Brother Umar Mamdou has very good, thank you very much, Brother Umar. For major differences between IFRS 17 and AAOIFI standards are: one, segregation of operator and PTF and PIF and applicability of participant fund only; a separate approach for unit-linked plans under Takaful. IFRS 17 has PA, GM and VFA. Instead of allocating expenses, Wakala fee is considered as expense. Please could you elaborate for unit-linked plan where the operator takes a fee for managing the unit-linked investment variable fee approach is applicable or not under AAOIFI? Actually, the unit-linked, Brother Umar, the unit-linked, the investment returns share in form of mudarib share or a vakil fee with or without incentive, that is covered in the last section of the standard. I think it happens many times that this standard is so long that although we are having nearly a 4-hour public hearing session, but we are unable to reach till the end. So what I suggest, let me complete this section and let me go to the last section, and we'll quickly take comments on that. And because the sister, I think we booked that time for the participant till 1.
Yes, Brother Martil 1.
These two are very long standards, and again, I can see we have answered 66 comments by now. So yeah, it's like, you know, it's always a pleasure to be available. I'll try to wrap it up shortly, but it's unfortunate that we are unable to do it all. So let me complete this section quickly and go to the last section where some of the questions raised by the attendees are to be answered. Okay. On the subsequent measurement part, the carrying value of the provision of the Takaful arrangement at the end of each reporting period shall be the sum of provision of remaining entitlement period comprising of the Takaful fulfillment cash flows and TRM. Both are to be, like, you know, both are to be reduced. This is again as per IFRS, so we are not bringing in any major difference here with IFRS. The liability for incurred claim comprising of Takaful fulfillment cash flows related to past benefits allocated to Takaful arrangement as of that date. The incurred claim part, we for most of the things we have put in incurred claim part. At some places we have put additional disclosure requirements as well, because of the issue that I mentioned earlier with regard to the discounting and non-discounting part. The income and expenses shall be recognized in the statement of financial activities of the managed PTF for the following changes: the revenue representing the reduction in provision, expenses representing losses, etc. I think we have taken note of your comment, comment that we have received from our respected participant. We will take care of this thing. We'll consider if it is actually going to impact. So this illustrative part is very important, even before finalizing the standard. So Brother Harun and Sister Farida, the illustrative part for the movement of the statement of financial activities of PTF is the most important before finalization of the standard. And I think we should take it to the working group and to the board because we need to be very clear about it. So even if the illustratives, overall illustrative financial statements may take time, but this part is very important. Okay, then we have income and expenses shall be recognized in the statement of financial activities of the following changes: expenses representing the increase in liability and because of claims and expenses, and expenses representing subsequent changes in Takaful fulfillment cash flows relating to incurred claims and expenses. Subsequent measurement shall take into account any experience adjustments. Now, this is an important point about experience adjustment. I think experience adjustment is there in IFRS as well, but I think we clarified it better after some discussion. So we clarified it clearly how it will actually, how the experience adjustment will be impacting the calculation of the fulfillment cash flows and the liability as of the end of the period. Subsequent measurement of residual margin at the end of the period represents the surplus in the Takaful arrangement that has not yet been recognized in the statement of financial activities of managed PTF because it relates to the future benefits to be provided under the Takaful arrangement. Sorry. The carrying amount of the TRM of a Takaful arrangement at the end of the reporting period equals the carrying amount at the end of the reporting period adjusted for the effect of any arrangements added in case of accounting being performed collectively or for a group, or the amortization of deferred Takaful residual margin over the entitlement period. So what we are doing, we are having the TRM, which is the total surplus. The future part of TRM is being kept on the balance sheet. The current part is being amortized over a period of time. So you actually come up with a systematic method of surplus of the profit coming to the statement of financial activities, which eventually may be converted into surplus or deficit depending on the total movement in the statement of financial activities. Some of these things are more detailed about how it actually is impacted and how it is calculated. And as I mentioned, most of these things are all related to and similar to IFRS 17. So I'm not going into detail for this part. I'll just touch upon the most important parts. The amortization of the Takaful residual margin, TRM, has to be taken to the statement of financial activities and shown as a separate line item. Subsequent changes and onerous arrangements, we have a subsection on that. Again, mostly aligned with IFRS, that whatever changes are there, they will be taken to the remaining, the provision for remaining period, excluding the loss component and all that, have to be accounted for on a systematic basis. With that, I think I'll move to again. These are the movement related requirements. Now, under the contribution allocation approach, it is the simplified model. So the application criteria will be more or less similar to IFRS. Whatever we have put in is almost similar to IFRS, that a simplified criteria may be used when either the results are expected to be more or less same under both the models, or no, mostly it will be applicable when you are applying the general approach. If you are having the general Takaful for which the period of transaction is limited. So we actually have more or less a simplified model, which is quite close to what is actually happening today, and that will be applicable mainly on general Takaful, we understand, and the short-term contracts even in the family Takaful. The long-term contracts, we believe, will generally not be eligible for this approach unless you can do the modeling and identify that this model is providing the same, more or less the same results as the general approach. One thing is there, as of now we have premium deficiency reserves and these requirements, but now we are moving towards the onerous thing. So even in the general Takaful, it is expected that because of the onerous thing, and particularly because in the PTF, as I mentioned, because in the PTF we are having wakala fee, which is quite excessive in case of a number of Takaful entities around the globe that we have seen as per data available. What we can say that onerous thing is something that is going to impact. Although there was premium deficiency reserve and other requirements were already there even under IFRS 4, but we expect that this is the only major impact that may impact a lot of Takaful companies, general Takaful companies. Their accounting may be impacted by the onerous commitments, onerous arrangements, which are on a higher side. So you need to recognize that at the beginning, which may be higher than the premium deficiency reserves or other reserves which are required by the regulators in different parts of the world. I'm not going for this detail because I believe that and this one and Rita Kaful again, I feel sorry that we don't have enough time. It's already more than 4 hours and we took a break only for 25 minutes, I think. So it's a very long standard. All the comments are welcome, but I would like to touch upon the last section right now because a lot of questions were related to that section. Rita Kaful arrangements, again, as I mentioned, more or less things are similar to IFRS 17. Your comments are more than welcome, and if you can provide any comments right now or later in writing, these are all welcome. But I would like to touch upon only the part E before we conclude today's session because we are already running late. So this part E is about accounting for Takaful institutions and significant issues related to business model of Takaful. So the first issue is about separation of accounting records, and there is a requirement that we have put in that must be the assets, liabilities, owners' equity, as well as income, expenditure, gains, and losses of the Takaful institution shall be recorded and reported separately and distinctly from assets, liabilities, surplus, distribution, deficit, and other related income expenditure of the managed PDF or the managed PIF. Recognition of initial seed money paid to PTF. It is not in Wakala Waqf model. It is mandatory. In Wakala model, at times it is done, at times it is not done. It depends on the regulatory requirement or it depends on the Sharia principles and rules and the Sharia view on that matter. But in case of Wakala Waqf model, it is mandatory. The Takaful institution at the time provides the initial seed money to set up the PTF. The seed money so paid is in the nature of riba. The Takaful institution does not have any remaining right on the seed money given to the PTF even at the time of liquidation of the PTF. So in the books of Takaful institution, as it is paid, it is paid, or when a irrevocable commitment is made for that, it is to be recognized as an expense. While in the books of the PTF, it has to be shown as a part of the PTF equity. Transfer of assets between various funds. This is an issue. We have a separate standard on transfer of assets, and we are working on revising that standard as well. But generally speaking, there is a rebuttable presumption that such assets in line with Sharia principles and rules are transferred between the Takaful institution and any of the managed funds or between two of the managed funds at fair value. Now, this is something which is we feel that there is a weakness as of now in respect of this issue in the Takaful industry, and we believe that again, it's an accounting standard, so it is an assumption. We cannot say you must transfer at fair value. Transferring at fair value is a regulatory or a Sharia decision or a business decision, but from accounting perspective, we are saying that it's understood, but if it is not done, then still there is a disclosure. Disclosure need to be made in line with the AAOIFI's relevant standard. Sister Farida, if you note it down, because since we are revising this standard, we need to say disclosure requirement in line with the relevant AAOIFI FAS, and in the footnote, we need to tell that it is currently FAS 21, and going forward, it will be a new FAS.
Revised, yeah, okay. Sure.
Yeah, so but we need to, in the body text, we'll say in line with the relevant AAOIFI FAS, and in the footnote, we'll mention FAS 21. Okay. Surplus deficit determination and surplus distribution. Takaful surplus or Takaful deficit shall be determined as the net surplus or deficit for the reporting period appearing in the statement of financial activities of the managed PTF in line with the requirements of this standard, read with the requirements of the other standard, the first standard, after due transfers from to the technical reserves. In case a Takaful institution determines surplus deficit in respect of a PTF in a manner different from the requirements of the above paragraph, the basis of determination of the same along with rationale of the same shall be disclosed. Because in some situation, it can be a cash basis or it can be a different basis according to Sharia principles and rules, or according to the contractual requirements or to the regulatory requirements. So in that situation, we generally believe that whatever is surplus deficit appearing in the PTF is directly distributable or attributable. But if it does not, if a different model is used, then that different model needs to be disclosed and the effect and rationale need to be disclosed. In case of deficit, the Takaful institution generally provides Qard Hasan, and then you need to see the Qard Hasan related provisions. A Takaful institution shall disclose the accumulated amount of deficit and its projections at least for 5 years with regard to the probable surplus and future periods to compensate for such deficit. This is an additional disclosure requirement and a very important disclosure requirement because it impacts the impairment of Qard Hasan as well. So it's a very important disclosure requirement, and I think it might not be very easy for the Takaful institution in the first years, but they need to work on this model. Risk reserves in PTF created out of Takaful surplus. If the Takaful surplus is distributable to the participants in line with the Sharia principles and rules as well as the contractual arrangement with the participants. However, at times Takaful institution creates set aside risk reserves in the PTF out of determined Takaful surplus for the reporting period. This is intended for managing the investment risk volatility, surplus deficit volatility, or any other suitable risk factors in the greater mutual benefit in line with the requirements of Sharia principles and rules as well as contractual arrangements with the participants. If this happens, then the AAOIFI FAS 35 requirements are to be fulfilled with regard to the disclosure and treatments. Adequate level of risk reserves. Again, the problem is that if there are risk reserves in line with the above requirement, those should be according to the adequate level of risk reserve as per FAS 35, suitably adapted to the nature of operation and investment style. A Takaful institution shall disclose the amount of surplus due to be distributed to the participant at the end of the reporting period, along with the reasons for delay in such distribution and details in respect of upcoming distribution of the same in terms of periodic amounts and the distribution methodology. Whatever approach is followed, these approaches are coming from AAOIFI Sharia standards, and these were part of AAOIFI's earlier standard on Takaful surplus distribution. So these are the approaches. We kept these approaches as the same, only we are asking for whichever approach is followed, you need to make appropriate disclosures for the same. Risk reserves in PIF. Normally in PIF, there are not risk reserves, but if risk reserves are created in PIF for the purpose of volatility, for the greater mutual benefit, those should also be according to FAS 35 and adequate level needs to be followed. Now coming to Qard Hasan. Qard Hasan accounting has been different in different parts of the world, and there have been a lot of issues, but from our framework and this standard, we are clarifying a few things very clear. Number one, Qard Hasan is a nature of temporary interest-free loan that shall be payable when the PTF accrues a surplus and or generates sufficient liquidity. So first thing is initial recognition it will be at par value, and always it will be at par value. Whenever it is received, PTF shall recognize it as a liability, and the PTF shall subsequently measure the liability at par value because there will be no discounting there. Waiver of Qard Hasan. When the Takaful institution waives off the right to receive Qard Hasan from the PTF, it's again not a good practice, but at times it happens. So according to regulatory requirement or otherwise, the PTF shall immediately recognize the liability and record the amount as its income for the PTF. In certain rare circumstances, the Takaful institution may contribute cash or another asset as hiba to the PTF, subject to Sharia principles and rules and the relevant legal and regulatory requirements. If hiba is paid, it will become Takaful institution shall recognize hiba in its books as an expense at the earlier of payment of cash or transfer of asset to PTF and making an irrevocable commitment for such payment or transfer. So hiba will be recognized as an expense by the Takaful institution and as an income by the PTF. Qard Hasan on the books of the Takaful institution, initially it will be recorded at par value of the amount paid. Sister Farida, there is a typo error here. Amount paid.
Okay.
Subsequent measurements and expected credit losses. Now, this is the major issue. If there are expected credit losses, means that the Takaful institution has paid Qard Hasan, but the fund is continuously in deficits and is not able to pay back, and that the disclosure requirement, as we asked about 5-year projection, that also dictates that there is not enough probability of receiving that, then the expected credit losses are to be recorded. So it has to be, again, we generally use the term impairment, but since it's a receivable, so the more appropriate term is expected credit loss, not the impairment. So this impairment or expected credit loss has to be accounted for in line with the requirements of AAOIFI FAS 30, which is close to IFRS 9 for that purpose. And waiver and write-off, again, it's the other way around of that, the counter accounting of the same. So it has to be, if it is written off, the receivable shall be recognized and corresponding expense shall be recorded by the institution. Recognition of wakala fee earned from PTF. The Takaful institution earns revenue in form of wakala management fee in different forms and under various contracts. The fee may be fixed or variable in nature. The wakala fee charged by the Takaful institution to the PTF is generally against performance obligation for various service costs, including the investment management function to be classified into, and the relevant revenue recognition shall commensurate with the relevant services as follows. Services initially or already delivered. Hence, related proportion. So what we are saying there are different type of services. So you identify the wakala fee, that how much proportion relates to the services initially or already delivered or services delivered over time and probable refund of wakala fee. So what we need to do is that we identify, for example, we receive 100 wakala fee, we say 33% is against the services already delivered. 50% is against the services to be incurred, and 15%, for example, is against the refunds, etc., or the probability of refund. So what we need to do is the wakala fee is to be recognized not upfront and not all deferred. Rather, it has to be divided in these 2 or 3 categories, and according to that, it needs to be recognized. So those services which are initially or already delivered, like initial booking claim or initial verification, and the marketing related expenses and commission also, if commission is coming from the coming in the wakala side. So this proportion will be recognized, this proportion of wakala will be recognized immediately. The other proportion of wakala will be according to services delivered over time and probable refund. So all of the wakala fee will not be immediately recognized, and all of the wakala fee will not be deferred. Rather, it will be according to the proper revenue recognition model. So it is in the books of the, here we are talking about the books of the institution. For the PTF, it becomes an expense immediately. So for that purpose, there has to be proper accounting policies in line with the contractual services and all these things, and it has to be accounted for properly. Takaful acquisition service cost in the books of the Takaful institution. So the Takaful acquisition service cost, if you recall, I mentioned that Takaful acquisition cash flows were related to PTF, and Takaful acquisition service cost is for the Takaful institution. The major part of it can be normally the commission, particularly for the first year and second year commissions at times are very material. So it can be recognized as an asset or liability in the book of Takaful institution to be amortized over a period which commensurate with the corresponding flow of economic benefits, provided that any such asset shall be subject to testing for impairment, and in case of cancellation for the respective Takaful arrangement, the liability may be distinguished and asset may be fully impaired. Sister Farida, please note down the term, the impairment here, because it's also in a form of a receivable or payable. So maybe the term impairment, instead of impairment, we need to use the same term, expected credit losses. No, here we will use that term impairment. I'm sorry. It's not a receivable or payable, so it will be impairment. Mudarib share. The Mudarib share will be recognized. Somebody asked about this issue. So Mudarib share from PIF and PTF. The Takaful institution shall recognize the Mudarib share arising out of the investment profits for the PTF and PIF after adjusting for any risk reserves as per contractual arrangements in line with Sharia principles and rules as revenue at the end of each reporting period. Wakala fee, fixed, variable, and performance incentive. The Takaful institution shall recognize the fixed wakala fee as well as any variable wakala fee which is not in form of performance incentive as its revenue in line with the contractual arrangements that establishes right on such revenue, and the same may be measurable with reasonable certainty. The Takaful institution shall recognize the variable element of wakala fee which is in form of performance incentives at the end of each reporting period. However, if such incentive is contractually determined at a later stage, the same shall be recognized once it is determined. Corresponding recognition by PTF and PIF. The PTF and PIF shall recognize corresponding costs for items provided in paragraph this to this at the same time as the Takaful institution recognize its revenue. Allocation charges. The Takaful institution shall recognize the allocation charges. Sister, it's not charge, it's charges, including wakala fee charges, a front-end fee, etc., by whatever name it called, charged to the participants in respect of the investments made in PIF as a part of net Takaful acquisition service cost or gain in line with the requirements of paragraph 116. The allocation charges shall be disclosed by the Takaful institution separately from other wakala fee. Now, what is this allocation charges? There are different names to it in different markets. That's why we will request a comment on that as well from you. If you can kindly provide some good comments on that. This is about the allocation of front-end fee or allocation directly to the unit-linked fund. So what happens that it is the first year major commission which is taken out of it. So we all understand the practice of first year and second year major amounts of commission. So how it is taken out, it is different in different countries, but most common practice that we saw is that out of the unit allocation, it is taken out as a wakala fee or a front end fee. So this is something that that needs to be accounted for in this manner, and we will really appreciate receiving comments on this point today or later. Taxation for PDF and PIF, we mentioned about that if there is a taxation effect that needs to be passed on. Effective date is right now 2024, and we are expecting that 2024 will be the effective date for both of the standards. Brother Kashif, your comment is taken with regard to the first year of adoption. On the transitional provisions, we have kept our transitional provisions similar to IFRS, which allow you full retrospective, modified retrospective, fair value approach, etc. With that, I can well understand that we are already nearly 18 minutes ahead of time. So I'll just let you know behind time. So let me conclude now with the just. So one comment was there by Brother Umar Mamdouh. Now I think you can find the unit-linked plans. What is the accounting policy for unit-linked plans here? I hope it resolves your query. Then there is another comment. When do we expect the illustrative financial statements to be available? To be honest, illustrative financial statements will take time. How much time it will take, I cannot tell, but it will take at least 6 months to 1 year. But we will start working on it. We started working a little bit, but now we will start working on it, but it will take a bit of time. But we will try our level best that before 2024, and when you actually develop the standards by beginning of 2024 or maximum by beginning of 2024, we make these illustrative financial statements available. Inshallah, that will be our utmost desire to be done on a priority basis. With that, I would like to thank you all for being here. We don't have any other comment in the QA box. Brother Sadaqat Khan says that I wanted to say a few words to her. So Brother Sadaqat Khan, Sister Farida, can you unmute Brother Sadaqat Khan?
Yeah.
Brother Sadaqat, there is not enough time. We just want to conclude, so there is not enough time. But thank you very much, sir, for joining here today.
Assalamu alaikum, Brother Umar.
Assalam,
Sadaqat, Deputy CEO of Allah International for Sharia Compliance based in UAE. First of all, thanks for your tireless and passionate presentation on the subject, besides responding prudently to the comments raised by the attendees. Hopefully, the exposure draft on accounting for Takaful and presentation and disclosure in the financial statement, once finalized and implemented, would resolve various issues currently being faced by Takaful industry. And we thanks and highly appreciate the efforts and contribution put in by all the respected members of the working group as well as AAOIFI Accounting Board. And we also pray that Almighty Allah Subhanahu wa Ta'ala may reward and grant Ajr Azim to all of you. And my personal salute to all of you again. Thank you very much.
Thank you very much, sir. Thank you for your kind appreciation and being here for us, for a senior person like you to be attending all these events. It's a great pleasure, sir. I know that it's already a bit late, so I would like to now conclude. I would like to thank all the participants for their for continuing for this nearly 4.5 hours public hearing. It's a great pleasure that we still have around 88 participants available here. It's to be honest, it is so much of a encouragement for us that the industry is responding to our request for these comments and everything in a very positive way. I can see some very kind comments on the chat window, and please, I would like to thank you all. Maybe we are not in a position to allow all of you to speak a few words, but I would like to thank, I think Brother Kashif, you want to say something? And Brother Kashif Siddiqui from Oman Capital Market Authority. Please, brother.
No, nothing special. Just to thank you for your session, actually. Thank you.
Okay. Thank you, Brother Kashif, for your kind comments, and you have continued your support throughout this project. Allah bless you, and Allah bless all those who have worked very hard for this project. We hope that we are able to finalize this in the next few months, inshallah. And as Brother Sadaqat said, that we hope that the industry gets improvement according to that, inshallah. Thank you. Assalamu alaikum wa rahmatullahi wa barakatuh.